There's just a lot going on, I think, in a positive way.
A lot of the uncertainty that was prevalent earlier in the year is really being washed out of the system right now.
Yes, you might see a slowdown in economic growth, but you're still seeing really resilient results from companies.
The AI theme has kicked back in.
The market's just in a particularly joyous place right now going into August.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, the records keep coming. 6 consecutive days of all-time highs for the U.S. equity market as Fed Chair Jay Powell begins a 2-day meeting with some clarity on trade. The backlash against the EU's agreement is beginning to brew across the continent. The euro weakness continues.
So it's exactly what you were saying yesterday. Let's see how long it takes before European leaders start to push back against this trade agreement that was, at least in principle, agreed upon yesterday between Ursula von der Leyen and Donald Trump. German Chancellor Friedrich Merz came out. He originally hailed the deal as something that was a success in avoiding a trade war. He said the German economy will suffer significant damage from these tariffs. The euro weakening yesterday, the biggest one-day weakening since May, with people assessing how much this reduces growth.
The French Prime Minister called it a submission. So there was a backlash in the FX market and a backlash in European capitals, but most people assume still the European member states will sign up to this. Can they follow through? Been crunching the numbers here at Bloomberg. The EU's aiming for $250 billion of US energy imports every single year for the next 3 years. Last year, that number was 80 billion.
Yeah, a lot of people are raising questions not only from the energy component, but also how feasible it is to invest $600 billion in the United States, let alone exactly what the details of this type of arrangement look like. So, as you were saying before, how binding is that, given the fact that this does seem to be one of the key components of this deal?
We've got a lot to work through this morning. Equity futures positive by 0.3%. Coming up this hour, we'll catch up with Peter Tchir of Academy Securities on why it's too early to declare victory on tariffs. Jeannette Lowe of Strategas on what's next for US trade talks. And Elsa Lignos of RBC on the dollar heading towards its first monthly gain this year. We begin this hour with our top story. A city in shock. A gunman taking 4 lives in a shooting at an office tower in Midtown Manhattan.
5 innocent people shot tonight. We lost 4 souls to another senseless act of gun violence, including a member of the New York City Police Department, Officer Islam. No words can describe this act of evil, a man who takes the life of others who are innocent. It's unimaginable to experience a loss of this magnitude.
Joining us now at the scene is Bloomberg's Miles Miller. Miles, welcome to the programme, sir. What's the latest this morning?
What we know this morning is that the suspect left a note in his pocket, and he said that he was targeting the NFL. This is a 27-year-old suspect, Shane Tamura, who drove cross-country from Nevada right here to Park Avenue, parked his car in the middle of Park Avenue, opened his trunk, and pulled out an M4 rifle. He walked right into this building and was intent on going to NFL headquarters to enact revenge against what he says is CTE. He says he played football, and because of his time playing football, he believes he has that chronic condition that is only really detected after people are dead and they can study their brain. He walked in this building yesterday and immediately shot an NYPD officer in the back and continued shooting until he got up to the 33rd floor. That's the headquarters of Rudin Management, a major property management company here in Manhattan. He shot an employee and then eventually turned the gun on himself.
Miles, there will be an obvious question this morning. How did this individual make his way to the 33rd floor of a Midtown Manhattan office building without the elevator being shut down?
Yeah, you know, one of the things in this investigation that we've learned is that a security guard behind the desk took cover. He was trying to take cover to prevent himself from being shot, and it's at that moment that he was killed by this suspect. A number of these buildings here in Midtown Manhattan have an elevator kill switch that can shut the elevators down so that no one can make it upstairs. But when you have that volley of shots in the lobby of this building and all the chaos, it's very difficult to operate in a situation like this. We also know that there were 2 NYPD officers in the building, one who was shot yesterday, and then another who was also working that detail, looking to determine whether that other officer was involved and engaged in this suspect. But what we do know is that this is something that's been on top of the minds of CEOs across the country, and specifically here in New York. It was just last year, Luigi Mangione coming here to Manhattan, shooting the head of United Healthcare's insurance group, the CEO, and it had everybody on notice because we knew that corporate security was going to be a major topic and that they would need to bolster security. They tried doing that here with that officer in the lobby, but what can you do when this officer is shot in the back?
A tragic loss of life. Miles Miller, thank you, sir. Miles, we'll catch up with you a little bit later this morning. Let's bring in the former FBI agent, Michael Harrigan, who joined us now for more. Michael, welcome to the programme. As our colleague Miles Miller was just discussing there, the second incident in 12 months in this city targeting corporations and representatives of those corporations. Do we need to rethink security for these organisations?
You know, absolutely. I think corporate security, I look at the work I've been doing with the PAX Group since the Mangione case in New York last year, is that corporate security nationally has done a lot of assessment of the measures they take to secure their workplaces, their people, and their executives. And in this instance, we have to look at this, and I'm sure there'll be a very close look at the security layout here, is how an individual with a rifle walking in plain sight could get into the lobby, then get into the elevator and get off at a floor and continue shooting. So they'll be looking very closely at a badging system. Why was there not a badging system in place for that, for the employees there in some type of controlled entry?
At a certain point, there's also a question about motivation and whether this was some sort of copycat measure. Is there something about the psychology that could breed further lone wolf attacks in a similar manner?
You know, absolutely. You know, disturbed individuals who either have mental illness or other gripes or grievances sometimes look to lash out in highly public areas and to attack companies of note. And here, what they're going to have to do is try to find out what this individual's motivation was. Look back in Las Vegas, they'll be looking extensively at his conversations with family and friends, internet connections, social media posts, because everybody wants to know the why. And the why here is good for the public to know, but it's also good for companies to know as they look to reassess their own security postures.
At a certain point, there's also this question about this does come just months after Luigi Mangione killed an executive from United Health, just 5 blocks away from where this incident occurred. What are corporate executives getting wrong about what had to happen to their security and what needs to happen going forward to prevent someone from coming in, shooting all the people, the attendants in the lobby, and just carrying on their way?
Well, it's natural in society and among businesses, too, to get lax in security over time. And it takes a concerted effort by company executives to put in place security measures. Security assessments have to be done regularly. Threats have to be looked at. Companies have to examine the intelligence that's out there. Are people, out there on the internet making threats or innuendos against their company? It's really a complete package that has to be put in place. And as we saw from the Mangione case, corporate executives have to take it seriously, their own personal protection, both at home and while they're on the road doing business. But really, the ultimate thing here is for Americans to feel secure in their workplaces, because when Americans don't feel secure in their workplaces, productivity suffers. So that's one of the biggest reasons to do corporate security and to take reasonable measures here is stop these attacks and help employees feel secure at work.
I'm sure many of those employees don't feel safe this morning, Michael, and that's the problem. And you and I are talking about the private sector response to this. What about the public sector response to this? What should the police commissioner, Jessica Tisch, be thinking about this morning?
Well, I think the big thing for her is to have a good information flow. She has to have good information flow to the media. The public needs to know what happened here, and they need to know the why behind it. And the more transparent the police can be in these instances, the better off it is, because always when you have a mass shooting or an active shooter, There's a lot of conspiracy theories out there, and people are worried. They're worried about whether there could be other individuals out there. Are there other businesses that could be targeted? So the police need to be transparent, and they have to be visible too. So I expect in that part of town today, you're going to see a lot of uniformed presence on the streets, and not just there, across the country. Law enforcement agencies have to be engaged with the community, and they have to foster good information sharing. Individuals have to feel comfortable going to the police and giving them information about individuals who are troubled out there, because that's where it starts. But we can't discount also the responsibility of every citizen when they have somebody who's suffering, a family member, a friend, or an associate, to step up, offer a helping hand, and also be a conduit to either work HR departments or to law enforcement to share their concerns so that these issues can be interdicted before they get to a violent end.
Michael, appreciate your input this morning. Thank you, sir. The former FBI agent, Michael Harrigan. Tragic events yesterday evening.
It really shatters the idea of safety. Once again, in the idea of a lone wolf potentially targeting a corporate workplace because of a grievance that's personal and that doesn't have to do with these specific individuals. I just wonder what has to be reassessed to make people feel safe again.
If you are just joining us, welcome to the programme. Plenty of updates throughout this morning on this programme on the tragic events unfolding yesterday evening. This morning, if you're looking at equity markets doing OK. Futures positive by 0.25%. For our top stories worldwide, with our Bloomberg brief, let's cross over to Yahara Arnott. Hey, Yahara.
Hi, John. As you guys were discussing, a gunman went on a rampage in a Manhattan office tower housing the NFL and Blackstone yesterday, killing 4 people before then killing himself. The gunman was targeting the NFL headquarters, but as Miles said, ended up on the wrong floor. Police say the suspect had a history of mental illness and believe he had driven cross-country to New York. Meanwhile, on the trade front, U.S. Commerce Secretary Howard Lutnick says a 90-day extension of a trade truce with China is likely. Negotiations between the two countries are still underway in Stockholm, with Treasury Secretary Scott Bessent leading talks for the U.S. Key sticking points include fentanyl trafficking and concerns around China purchasing sanctioned Russian and Iranian oil. And Stellantis shares are falling 3.5% in the pre-market. The automaker shared it expects to take a $1.4 billion hit from tariffs in the second half of this year. This coming after Stellantis recorded in the first half of the year a near $350 million impact from tariffs and lost production. Shares, as you can see, are down more than 25% this year. That's your Bloomberg brief. John.
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, more trade deals on the way.
The president's going to decide, look, this is how I want to play it. He may entertain a few more deals, or he may decide, you know what, I'm just going to set the policy going forward. But by the end of this week, they will all be set, they will all be in stone, and they will be written.
Up next, Peter Tchir of Academy Securities, live from New York City this morning. Good morning. A ton of data this week, including lots of labour market data. It starts this morning at 10 a.m. Eastern Time when you get JOLTS job openings. Look out for that. Of course, it concludes on Friday with payrolls Friday, and sandwiched in between tomorrow, a Federal Reserve interest rate decision. If you are just joining us, welcome to the programme. Equity futures look like this morning. We are positive by 0.3%, on the Nasdaq up by 0.4. Under surveillance this morning, more trade deals on the way.
The president's going to decide, look, this is how I want to play it. He may entertain a few more deals, or he may decide, you know what, I'm just going to set the policy going forward. But by the end of this week, they will all be set, they will all be in stone, and they will be written, and we will start collecting those additional monies. Right now, we're collecting 10% from everybody in the world, and of course, a higher rate from China. But come next week, off we go.
Here's the latest this morning. Commerce Secretary Howard Lutnick saying a 90-day extension of a truce with China is likely, with President Trump's Friday deadline for other countries fast approaching. Our team coverage starts right now with Bloomberg's Tyler Kendall in Washington and Ollie Crook in Stockholm. Tyler, just to come to you first, set the stage for us for the next few days.
Yeah. Hey, John. Good morning. Well, the White House is trying to get some additional details done and out when it comes to these trade frameworks. But at the same time, you heard the Commerce Secretary Howard Lutnick there say that they're not interested in extending that August 1st deadline. And he essentially laid out two options for our trading partners. One, President Trump may entertain some more announcements, or he's just going to set the rate. And that's raising some serious questions for some of our trading partners that are steeped in the negotiations and have long been prioritized in the talks, but haven't yet emerged with some sort of framework announcement. That includes South Korea, for example. We heard Howard Lutnick say in that interview that the South Koreans actually flew to Scotland yesterday to meet with him and the USTR Jamieson Greer. And also big questions around India, another trading partner that we know has long been prioritized in these talks, but has seemed to sort of harden its stance during these negotiations, including when it comes to market access for U.S. industrial and agricultural products. Some other key trading partners that we're waiting to see if their rates get lowered include Canada and Mexico as well, John. Of course, these two countries were tariffed totally separately, not on Liberation Day, yet they have also found themselves up against that August 1st deadline.
Ollie, we've had lots of clarity in the past few weeks. I think investors just hoping now we kick the can with regards to China. Can we just kick the can and extend this another 90 days?
I think that's the base case, Jonathan. The expectation after 5 hours of talks between the U.S. Treasury Secretary Scott Bessent, Jamieson Greer, and the Vice Premier of China yesterday. They spoke for about 5 hours in Sweden's Prime Minister's office. They just walked in about an hour and a half ago to extend those conversations, and we're hoping to have an outcome some point in the afternoon, hopefully here from both sides. The expectation, Jonathan, as you say, is to get another extension to that trade truce that will leave the tariff level at 30% from the U.S. side onto China, down from that 125% level that we had at the sort of height of the trade war between the two sides, because the deadline right now is August the 12th. They're hoping to extend that. In terms of a longer framework, in terms of an actual agreement between China and the United States, I mean, you guys know how difficult and how elusive that conversation is going to be. I'll just say that it really is interesting to see what we've seen between the European Union and the United States and China and the United States, and the contrast there. The Europeans went on the side of pragmatism. Not everybody is happy about it, but there's the issue of pride, and pride is a much more active ingredient in the conversations with China and the United States. China has been building itself up economically, geopolitically across the world for the last several decades. They do not want to be seen to giving more to the United States than they have to, whereas the Europeans, in contrast, sort of want to appear to be giving more than they actually are. And that is really going to be the sticking point here. As we know, that Trump himself says he does not want to go to China just because he wants to go to. He's going there by invitation. So pride is a very sort of active role in these discussions. Hopefully we'll get something from the U.S. Treasury Secretary in a couple of hours' time.
Ollie, appreciate the update. Stay close. Ollie Crook there, alongside Tyler Kendall. Peter Tchir of Academy Securities with us around the table this morning. Good morning, Pete.
Morning, John.
Good to see you, sir. Tariff revenue, how large and how bond positive is it going to be?
So I think that's the one thing we're missing. So the last 2 months, we've generated about 20 billion extra. So for the last 5 years, we ran between 8 and 9 billion a month in tariff revenue. That's popped to 28 billion. It probably goes down a little bit, then some sort of steady pace, probably around that 30 billion. That will offset a lot of the deficit. I think that's a good part. But now it also explains why we haven't seen tariffs hit the economy at all, right? Only 50 billion, 60 billion so far. It's a tiny drop in the bucket of this economy. If you think about a company, even if they turn their inventory over twice a year, it's going to take 6 months or so before they have all their inventory affected by tariffs. So I think the inflation pressures from tariffs, the earning pressure from tariffs are down the road. And the other problem that we're seeing, I think, a little bit, it's hard to decipher, is it seems like it's hitting small and mid-sized companies much harder than large corporations, right? Large cap companies had the working capital, they had the ability to move their shipments around. It hasn't happened about the small and mid-sized companies, and I think that's taking time to leak into the data.
So you can push through that idea into the bond market, as John was sort of hinting, and both of these would be supportive for the bond market. They might question the stock market a little bit more in terms of any kind of pressures to growth. Is that your thesis here?
Yeah, I think we're back at 440 on 10s. This is sort of level I start liking them again. I think we should be much closer to 4%. I think Powell's going to have to cut a little bit, and I think all the fears about the deficit, while real, they're missing some of this trade, tariff revenue, and I think we've got to be really, cautious, or think about it this way, right? President Trump, Howard Lutnick, right now they are seeing all the benefits of tariffs, this additional revenue. They're not yet seeing the downside. So I think they're going to continue to push on that, and they're going to wait to see if there are problems. That might be when they back off or change their tune. But right now they'll drive those revenues. They'll try and get the deficit down. And I think the bond market's kind of missing that whole story.
This is bond positive in terms of lowering the deficit as well as potentially slowing growth. It doesn't sound particularly positive for stocks, which just had their 6th straight record close. If they're seeing a 7th today, that would be the first time going back to November of 2021. And stocks haven't moved more than 1% in a month. Is this a shock-proof economy, as Rick Rieder is saying, or is this something that maybe is just in denial?
So I think, the tariff is actually pushing down on stocks. On the other side, what you've got, I think, is this, we've been calling it Academy Securities, national production for national security, right? We have to produce and make things that are good for national security. So 2 weeks ago, the Department of Defense invested $400 million in MP. They got $1.1 billion of debt. Bassett, I think last week when he was on with Annmarie, basically almost said those exact words of, national production for national security. And then President Trump went on about data and AI and how important it is, how we're going to make sure we have the electricity for AI to run. So I think there's a lot of support for that. And I think that's actually what's propelling the market. That's also why it's very concentrated in a handful of sectors.
I'm pleased Lisa mentioned Rick Rieder. It's a fantastic piece of the Financial Times if you happen to read it. There's a quote in front of me. Markets are not ignoring risk. They're pricing a system built to absorb it. A service-oriented economy, fortress balance sheets, and a liquidity-rich investor base deliver a 2-for-1. Resilient growth and elevated fixed income yields. That's the power of US financial markets. How does the rest of the world compete with it?
Well, weirdly, they're doing pretty well. Especially, the one thing I think we're missing right now is part of what's driven, I think, the U.S. stock market return is the weakness in the dollar, right? DXY is down significantly. All of a sudden, you're seeing DXY creep back higher, right? And I think the lower dollar has been a big benefit. You look at European, stock markets. For a U.S. dollar investor, they're up significantly more because of that. So I think the weak dollar, if that starts reversing, that will actually put some pressure on U.S. stocks. I do think we're resilient. I think it's about the growth story. And the one thing, that really ties in nicely to this whole, national production for national security is the accelerated depreciation and a couple other things in the big, beautiful bill. If we can just jumpstart that, there is that opportunity. So I think there is a growth element with this tariff, and those are kind of balancing out. I think right now the growth story makes sense.
Correlations were really messy in April. Have we re-established more intuitive correlations between risk, between equities, bonds, and foreign exchange for that matter?
I think they're normalizing a little bit. And again, it's, we talk about some of these negative trade deals for Europe and other places. Their stock markets continue to do well. If you look at FXI as, an ETF on China, it's actually way outperformed the U.S. So, yes, we've been successful, but other countries seem to be doing well. And I think when I look at these tariff deals, I think what you had is a situation where countries that all of a sudden in shock. You can't just say, whoa, I'm walking away from the U.S. We will see what the world economy looks like 6 months or a year down the road, right? Everyone's going to come to the table. Everyone's going to say some sort of deal. But then what do they really try and do? Are they content to try and work with the U.S., or are they going to try and figure out alternatives? At one time, EU was starting a trade deal with Canada. That kind of died. Do things like that get resurrected? And the other thing is, I think we're seeing tariff mitigation strategies across the board. Canada, Mexico, USMCA compliant goods, they're getting approval for those things. So it's not as bad as it looks either.
Earlier this year, you were concerned about the tainting of the American brand and how there'd be a boycott internationally. You sound a lot more positive now. Why?
So I'm still worried about where we're seeing that. I think you're seeing it in tourism. You've seen it in certain car companies. I feel like they're not getting the sales globally. So I think that will all take time. I think we've changed the tone from less punishment to, okay, let's try and make deals. And it seems like the president has softened. I think we've also had some big successes. I'll go back, and a lot of it changed for me when we attacked, Iran's nuclear facilities. All of a sudden, it was the U.S., acting as the global superpower, really doing something incredibly impressive. And I think that was a big win and sent a message to the rest of the world. Okay, the U.S. hasn't gone back and gone completely isolationist. They are still doing there. So to me, that would also really help change the narrative, I think, globally. What is the U.S.? So I think that was one of the most, instrumental things that the administration has done, is that attack on Iran.
There was a worry also that August 1st would just become the new July 9th, and this would continue, the new April 2nd, and this would continue through the next, 12 months.
Yeah, and so you get some certainty. Maybe Thursday, of course, we have a potential court ruling that could upend some of that certainty. But at least there is a path of travel that people can understand for now in terms of what at least the ceiling could be and what the floor is.
We'll talk about that court ruling in just a moment. Peter Tchir of Academy, it's good to see you, sir. Pete, thank you. Up next on the programme, Jeannette Lowe of Strategas as backlash brews in the EU over the US trade deal. Plus, Danny Berger with your morning movers. UPS falling after pulling its full year guidance. That stock is down by 3%. From New York, you're watching Bloomberg TV. Massive week for earnings. $11 trillion of tech earnings coming up. 20% of the S&P 500 across just 4 names. Those 4 names start to report tomorrow afternoon. Equity futures add some weight to the rally, up by 0.3% on the S&P, up by 0.4% on the Nasdaq 100. 6 consecutive days of all-time highs on the S&P. With 3 hours until the opening bell with your morning movers, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Some earnings to work through this morning. About half an hour ago, we got United Health Group, and they had pulled their 2025 guidance. They reinstated it, and it was a disappointment. $16 is where they see their earnings for the year. The estimate was $20.40. It's a group that's been hit with issue after issue with higher medical costs, reports of regulators, investigation. They really needed to restore confidence. This certainly will not help with shares down 3.3%. We also heard from UPS this morning. For them, it is a cut, or rather a non-issuance of their guidance, pulling their year forecast down 2.5%. They are citing macro uncertainty, saying that it is a very complex environment for them as they try to retool their network. Finally, we also had Whirlpool earnings as well. Now, this is an appliance maker that makes most of their things in the U.S., so it was supposed to be a beneficiary of tariffs abroad, but instead the company says that its rivals, specifically those in Asia, pulled forward everything, shipped in to beat the tariffs, so they didn't get that boost. It also doesn't help that the macro environment isn't great for them either. They blamed slowing home sales, so those shares down 16% with a miss and a cut to their outlook, John.
Danny, appreciate it. Thank you. Danny's going to keep working through the earnings throughout this morning. Just to pick up on UPS briefly, the obvious response to a report like that, is that a UPS problem? Or have we got a problem with this economy?
That was exactly what I was thinking. UPS is trying to rejigger its structure for quite a while, in part because of a strike from the union, as well as some of the competition that you're seeing from the likes of Amazon. That said, this used to be a bellwether for consumer demand and for package volume. How much is that also a part of it, as we do hear more warnings on how much the tariffs are going to hit?
The stock is down by 2.6%. In early trading. On our radar this morning, our top story, a gunman fatally shooting 4 people in a Midtown Manhattan office building on Monday evening. The NYPD identifying the alleged shooter as a 27-year-old man who drove to New York from Nevada.
There are so many parts of this story. From a corporate security standpoint, there's a question of whether this is an increasing trend with respect to corporations being targeted by people with specific grievances, regardless of where they're coming from in the country. The fact that this happened 5 blocks away from where the United Health shooting happened, really notable. There's also a question about why someone with mental health issues had a license to have a concealed military-grade weapon at any point, who could just walk in plain sight into a building and then engage in this type of violence.
That's what's concerning. You want to give the NYPD the space to continue the investigation. Of course, everyone is going to do that, and we'll get you updates throughout this morning. But a lot of people will be very anxious about returning to work this morning, particularly in Midtown Manhattan, given the ease at which this took place yesterday evening.
And so what kind of assurance can there be that there is enough oversight, and how difficult is it? And this is something that we need to keep exploring. How difficult is it when you do have a lone wolf attack, when there isn't necessarily the telltale signs that people can track at any given point?
We'll catch up with the team at the scene in about 30 minutes from now. For an update on trade talks between the US and China, they enter a second day in Stockholm. The Commerce Secretary, Howard Lutnick, saying another 90-day extension of a trade truce with China is the likely outcome. And I have to say, for many investors, that's the desired outcome as well.
If you just keep kicking the can, it's probably easier than trying to come up with something in a pretty fraught relationship. You wonder what's involved in the ongoing prolonging of this deadline. It's not just the trade aspects. The Taiwanese president was going to make a stop in the United States on his way to a host of American countries, and President Trump didn't let him stop in New York City. And there are rumors that maybe he called off his trip, that maybe President Trump is reconsidering, but you wonder why. And there was some speculation that this was part of the negotiations to try to pave the pathway for a better conversation with the Chinese counterparts in Stockholm. Again, what are the geopolitical elements of some of these trade deals? You can point to Russia and Ukraine and all of these other things, but that's really where I'm focused.
Chinese officials are very good at dragging this out, and dragging this out. And I think US officials, particularly these negotiators, are well aware of that the Chinese are always looking to buy time, because they understand the political cycle and things move on. And I understand that the Treasury Secretary, Scott Bessent, will have that in mind as he pushes them aggressively to rebalance their economy. This is something we've talked about for years, something that's good for them, good for the global economy, something they've been reluctant to do. Can they finally get it done? Now there's a better agreement with the EU, at least for the US side of things, in the past few days.
You raise a great point. If they have a tendency to prolong and prolong and prolong from the Chinese side, how much leverage does the United States have to really push back against that, given the fact that the rare earths metals are instrumental in the cars, the phones, everything that we use on a day-to-day basis in the United States? And that is the rub that we experienced after April 2nd.
This conversation has big consequences for the following company. Apple reports later this week they're set to close a retail store in China for the first time ever. The decision following Apple's ongoing sales struggles in the country as local competition continues to gain ground. That stock is unchanged this morning. It is down by double digits on the year so far, and it has been a tricky year so far.
Especially when it comes to their China strategy. Just to give you a sense of what kind of footprint it has, the greater China region has about 56 stores that are from Apple in the entire region. That's about 10% of its footprint. This goes to a global story, though, for Apple, which is they were in expansion mode until the pandemic. And then since the pandemic, they've really slowed in terms of how many stores they've been opening. And there's been this feeling that maybe they're reaching a saturation point. So for Apple, how do they give a sense that they're going to hit some sort of growth cycle, given the fact that you're not seeing the upgrades, that there's a question around technological prowess and how much of an advancement they have, and then there are all these extra costs from tariffs and geopolitical risk, and that, I think, is really going to be in focus for Apple on Thursday.
There's no growth.
Yeah.
There's next to no growth for the king of hardware, which is Apple, and they've been a king of hardware for a long, long time, a luxury item that everyone wanted. And now, to your point, the technological progress of the last 12 months or so, and they just don't seem to be in the lead in any way, shape or form. And Meta has been going after them big time, after their talent.
Yeah, and this is the reason why the shares are down some 15% this year. It's notable that yesterday we saw the Magnificent Seven reach its first record high so far this year, even though you see Apple down 15% so far this year. Even though Tesla's down 19%, it raises a question of whether they belong in the same kind of rubric as these others, because they don't have that growth that really was underpinning some of the gains that we saw in the stocks earlier.
Apple reports in 2 days' time. Let's turn back to trade. Negotiations between the US and China are concluding at Stockholm today. The Commerce Secretary, Howard Lutnick, expecting a 90-day extension of the current trade truce. Jeannette Lowe of Strategas writes, assuming there is a 90-day extension of the current tariffs on China, we are only waiting for clarity on the rates for 40% of the remaining goods that will be subject to reciprocal tariffs. Jeannette, I'm pleased to say, joins us now for more. Jeannette, I want to start the conversation where Lisa was leading us to about 10 minutes ago, which is whether these tariffs will actually survive the legal process in this country. What are you telling clients about that?
Yeah, so I think this is a big week, obviously, for the tariff the legal argument with regard to the IEEPA tariffs, or the International Emergency Economic Powers Act tariff. And so that is going to happen on Thursday. We're just going to get oral arguments. We may not have a decision before August, potentially even later into the year. And this is also likely going to go to the Supreme Court. I think for some points, the president probably wants to get these trade deals in place before there could be some decision that might provide more uncertainty for the market about whether or not these tariffs can be put into place under that legal authority. But one of the things that we try to remind our clients is that even if these tariffs are overturned ultimately by the Supreme Court, they can be reimposed under other methods. They wouldn't be necessarily as efficient, but the president can still use Section 122 authority to put tariffs in immediately. He can also use Section 301 investigations to go after unfair trade practices. So even if they get overturned, it will create uncertainty, but wouldn't necessarily be the end of the tariff story.
Which really raises the question about where we are in the 232, the Section 232 tariff investigations, and this idea of some of these parallel tariff methods that are being explored in other avenues, just in case there is this type of outcome. How close are we to seeing tariffs signed off on from those other provisions that could really bypass some of the legal scrutiny?
Right. And so this is really important because obviously the Section 232 tariffs are not being challenged legally under this court case. And this is what is going after critical areas that the president would also like to see more domestic manufacturing. So semiconductors, pharmaceuticals, critical minerals, auto tariffs, the steel and aluminum, all of those would remain in place. We do continue to hear from the president and the White House that they are going to announce at least the report on the investigation into pharmaceutical imports and semiconductor imports, but the president has also promised to give a 1-year delay on the pharmaceutical tariffs. So that's something that we're going to be watching for, especially as we go into Friday. And then also what happens with semiconductors. Do we announce them and have the tariffs go into effect relatively soon? Or does that also get a delay like pharmaceutical tariffs? I think that'll be quite important because the tariff story is not quite done even with this August 1st deadline.
Jeannette, I was very excited to think that we were getting some greater degree of certainty when it came to the framework of trade going forward. And that seems to be what the market's been cheering over the past few days. Are you telling clients don't get so secure in that idea? Because ultimately we could see some pretty dramatic changes to this framework, whether from legal or whether it's from adjusting just what provisions these tariffs come from.
Well, I think what we've noticed is that, especially once the tax bill came into effect, I think a lot of investors were a little bit less worried about the impact of the tariffs because the tax bill does offset and provide some relief for consumers and businesses and helps to offset the impact of the tariffs. And then there was a lot of focus on getting more certainty about the trade deals, knowing what the rate would be and having that certainty to be able to move forward and make decisions. But we do kind of continue to point out that this isn't necessarily over. We will probably have some trade deals, but again, these sectoral tariffs continue to play a role. There are also other investigations that are currently in place. So you still have lumber, critical minerals. They're looking at aircraft. So there's a whole host of other things where you can't necessarily be complacent that the tariff fight is over. And then I do think whatever happens with the courts will potentially add some uncertainty that investors do need to be aware of.
Jeannette, we've got some experience with purchase agreements. We have that experience in the president's first term. And at the time, you remember, we all had a similar conversation. What is the enforcement mechanism? How binding are these agreements? And I think those conversations have started again, not just with the EU, but with Japan as well. Just how binding are these agreements between these countries?
Yeah, I mean, you had the conversation where Trump actually asked the EU at the meeting on Sunday and said, how do we know that you're actually going to follow through with these investments? And they, had the idea to list off which investments various companies were planning to do in the United States. But of course, that is a question, whether or not it is enforceable and how. The big point is that this is still a framework. We still have a lot of details that still need to be worked out. The EU continues to kind of imply that there could be new developments to this deal. Could there actually be a quota system for the steel and aluminum tariffs? So then how do we see what that framework looks like for the investments from the European side, from the Japanese side? If there's another deal to be announced in the coming days, how does all of that work? So I think that is still an open question because, of course, I think the president is also thinking about his deal with China back in 2018 and whether or not China actually followed through with its purchase agreements and how does that play going forward. And I think he'll continue to use tariffs to hold a threat over if he doesn't feel like those investments are happening.
Jeannette, appreciate the reaction from you. Jeannette Lowe there at Strategas, and right on cue, this headline crosses the Bloomberg terminal just moments ago. The EU intends to purchase 40 billion euros worth of AI chips in a trade pact with the US.
So I'm just throwing this out there. How much of that purchasing power was already planned to try to get some chips on board at a time when that is the future for so many different corporations? It just raises a question. Is this just codifying the investments that companies were already making in the United States, putting them on a nice list, packaging them and saying you can go and you can celebrate this in a Rose Garden ceremony and say that you've got a win? Or is this actual new investment that's coming in from government sources?
I think when it comes to energy, and we could talk about energy specifically, it's redirected the spending that was going towards Russia to the United States. And I remember when Will Kennedy, who led our energy coverage months and months ago, said that to get to an agreement here is like pushing on an open door. The EU wants to buy that energy, that LNG from the United States, and the US wants to sell it. Now, the Biden White House had other ideas, But this White House wants to make that happen. So I think that is something that we can make happen in the years to come.
And I wonder how much that was part of the announcement after yesterday's trade deal was announced between the U.S. and Europe, that President Trump said he is going to shrink the amount of time that Vladimir Putin had to really respond to the demand for a ceasefire with Ukraine to 10 to 11 days rather than 40, saying, all right, let's get a deal. I wonder how much that was part of this discussion with the Europeans.
Can we get to 250 billion every single year? I don't know.
Question,
Can we get above 80?
Yeah.
Sure. There's no reason why we can't. Let's get you an update on stories elsewhere this morning. With your Bloomberg brief, let's cross over to Yahira. Hey, Yahira.
Hi, John. We start with yesterday's tragic shooting. A gunman opened fire inside a Manhattan office tower housing the NFL and Blackstone, killing 4 people before killing himself. Authorities say he intended to target the NFL, but ended up on the wrong floor. A manifesto found on him and social media posts reveal an obsession with CTE and anger toward the NFL over how it handles head injuries. Meanwhile, as countries race to secure trade deals with the U.S., talks with India are coming up short. U.S. Trade Representative Jamieson Greer shared more negotiations will be needed to secure a deal ahead of President Trump's August 1st deadline. Greer highlighted India's historic policy towards protecting its market, but said they are having constructive discussions. And Taiwanese President Lai Ching-te appeared to call off a U.S. trip planned for next week after the Trump administration failed to greenlight his U.S. stopover amid concerns it could derail trade talks with China. Lai had planned to stop in New York and Dallas, but officials could not get U.S. counterparts to approve that visit. That's your Bloomberg brief. John?
Yahira, thank you. Thanks for the update. Up next on the programme, backlash brews in Europe.
We have a trade deal between the 2 largest economies in the world. It's a huge deal with tough negotiations. I knew it at the beginning, and it was indeed very tough.
And the pushback begins. We'll catch up with Elsa Lignos of RBC up next. On Stock in Focus this morning, this in Europe, Stellantis down by 1.98%, down yesterday by 2.7% on the back of the trade deal with the United States. This morning, Europe and European companies putting a price on it.
Yeah, in particular car companies that have already been struggling. Stellantis reintroduced some guidance, although Jefferies called it vague, and it included a 1.2 billion euro hit in the second half of this year tied to tariffs at a time where they already are dealing with an overhaul of their different auto chains and falling sales. It just goes to show you're punished if you withdraw guidance, as we've seen from UPS, and you're punished if you issue a vague guidance that doesn't show a pathway to growth, as we're seeing with Stellantis.
Confident optimism.
Exactly.
Seems to be what's needed. That's what you're getting from US markets at the moment. 6 consecutive days of all-time highs. Futures positive by 0.3%. Under surveillance this morning, backlash brews in Europe.
We have a trade deal between the 2 largest economies in the world. And it's a big deal, and it will bring stability. It's 15% tariffs across the board, all inclusive. The European market is open. It's 450 million people. It's a huge deal with tough negotiations. I knew it at the beginning, and it was indeed very tough, but we came to a good conclusion for both sides.
Here's the latest this morning. The euro falling to its weakest level against the dollar in 5 weeks as European leaders push back against the EU's trade deal with the US. The French Prime Minister saying, quote, "It is a dark day when an alliance of free peoples gather to affirm their values and defend their interests resolves to submit." Elsa Lignos of RBC joins us now for more. Elsa, that's the rhetoric coming out of Europe this morning. I just wonder how empty it is. Are they pushing back because they're not going to sign up to this, or ultimately is that the direction of travel?
And there is a challenge here, and Ursula von der Leyen admitted it herself, that any legal trade deal has to get through member state approval. But at the moment, what we have is a non-legally binding agreement lacking on specifics. And we haven't even reached the stage yet where we're going to get a little bit more of the specific detail coming out. We've just had the fact sheet from the US side, some details coming out from the European side, not always perfect alignment either between the two.
It looks like a very one-sided deal in the US's favour, that's for sure. That's the view of lots of people. So I just wonder what that means for a currency pair that's been moving in the other direction pretty aggressively over the past few months.
It's a great question, because I think the deal, as you say, pretty one-sided, undermines two key tenets of the dollar bearishness, euro bullishness that has held year to date. And the first is that there was big expectation of rotation out of US assets and into European assets. And we saw yesterday and today, European equities not loving this, European defense stocks coming under pressure because, of course, the flow is going to be more directed towards US defense stocks. But on top of that, it is likely to be inflationary for the US. And so that calls into question the ability of the Fed to cut rates aggressively, which again is a key tenet of the Eurodollar bearish outlook. All of that said, the longer term direction of travel for many people is still higher, ourselves included, because we do think the Fed is going to be cutting rates, albeit perhaps with a later start. And so as you get into 2026, there will be longer term investors who are underhedged, who are still looking for levels to get into those long euro-dollar positions. And this pullback is a gift to them.
So just to put a bow on that, is this essentially a buying opportunity for you for the euro?
Yeah, I mean, I think you already saw that a little bit this morning where, we were trading around 115.80, had that quick dip down to 115.30, and it was fairly quickly erased. And I think people will be looking to layer into hedges, and 115 is not a bad level if you've got a 1 to 2-year outlook. There is the negative carry, but, from a long run perspective, Eurodollar does remain cheap at current valuations.
Given the fact that there's a lot of concern about what this means for European growth, you have Deutsche Bank analysts coming out this morning and says that they're reducing their European GDP expectation by 0.5% as a result of these tariffs. Does that influence your bullish call on the euro at all, or is that sort of just something that you had expected?
Well, it's already factored in. I mean, up until not so long ago, I was being questioned on why my call on the euro was not more bullish. So we had 117 for the end of this quarter, heading up to 124 by the end of next year. And, part of the reason it wasn't more bullish was precisely, as you say, the European growth outlook, it's decent, but it's not spectacular. The ECB appears to be done, but rates are still significantly lower than they are in the US. So a lot of that is already factored into, why we're not calling for Eurodollar to stay at 135 or 140. The flip side, though, is that as the Fed cuts rates, and unless, you really have a view that the Fed is not going to be cutting any time in the next 18 months, the reality is that yield differential is going to compress at the front end, and that should lead to a lot more in the way of hedging flow.
Elsa, just to finish on rate differentials, for anyone introduced to foreign exchange 101, it's rate differentials. But I just wonder how relevant they've been in this market regime over the past 12 months, because this euro has rallied through an easing cycle at the ECB that the Federal Reserve so far this year hasn't participated in. How relevant are rate differentials?
Exactly. It's a great question. I think this highlights how much of this rally has been investors anticipating what's to come rather than trading on what's right in front of them here and now. So there's been a broad expectation that the Fed is going to be cutting rates, that the ECB is pretty much done with easing, and therefore that you are going to get this switch into euro dollar hedges, and at the same time a broad expectation that you're going to get rotation out of US assets into European assets. And sometimes when it's speculative positioning ahead of the actual reality coming to fruition, you can get these positioning-led pullbacks like the one we're seeing at the moment.
Elsa, appreciate the reaction. Thanks for the input. Elsa Lignos there of RBC on the FX markets. And welcome news for those of you with an August vacation booked. Euro-dollar 115.75.
Yeah, maybe not such great news, though, for companies, because this is one of the bull cases for corporate America,
Big
given
tailwind.
the fact it's a huge tailwind when you have a competitive advantage in the form of a weaker dollar. So let's see how far this can go based on just how lopsided positioning had gotten heading into this.
This morning is like the calm before the financial market storm over the next 2 days. In many ways, the week begins tomorrow, right? Earnings, Federal Reserve, then we make our way towards payrolls on Friday.
And it's not just a number of actions that we're going to get tomorrow and on Thursday. It is a series of blockbuster releases that could define the remaining half of this year. And so, yes, I would argue maybe we've been seeing the calm before the storm for the past, 6 months.
In the meantime, the grind higher continues, up by 0.3% on the S&P. Up next, we'll catch up with the former FBI Executive Officer Michael King. Mike Wilson of Morgan Stanley will speak to the former U.S. Trade Representative Susan Schwab and Dominic Rizzo of T. Rowe Price. From New York City, good morning. The second hour of Bloomberg Surveillance. Up next.
think you can't say that this labor market's not in transition.
The labor market is okay now, but the risks are rising.
We do think we'll see a cut in September and in December, and there's a possibility of even more cuts next year.
I don't think anyone's debating right now whether or not the Fed's going to hike. It's just a matter of when they cut.
The question is not simply, is the Fed cutting rates, but by how much?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The grind higher continues. The second hour of Bloomberg Surveillance starts right now. 6 days of gains on the S&P 500, 6 consecutive all-time highs. Can we make it day 7 up by 0.3% on the S&P, and the Nasdaq 100 up by 0.5. As we said a little bit earlier this morning, it's the calm potentially before the financial market storm. Earnings coming up this week. Tomorrow, Meta, Microsoft. Thursday, Apple, Amazon, and then the data. The data starts this morning. 10 a.m. Eastern Time with the JOLTS number, and then it picks up through the week and concludes with payrolls on Friday.
And all of this is going to set the tone at a time where we haven't seen the S&P move more than 1% in a month. Just to give you a sense of how, yes, this has been a grind higher, but it's been a grind. To put some numbers on that earnings flood, as you were talking about, we're getting $3.2 trillion of earnings of the S&P today. We're getting $7.6 trillion worth of market cap tomorrow and $8.8 trillion on Thursday. At the same time, that potentially we get some guidance from the Fed about how they're looking at the record highs and the strength in corporate America and how they're going to use that and still justify cutting rates later in the fall.
Just how extended is this rally? This came from Jonathan Krinsky of BTIG. It's the S&P's longest streak above its 20-day moving average since 1997. He concludes the clock is ticking for a shakeout.
Yeah, but if you call it a bubble, you're going to start triggering people, in particular Max Kettner over at HSBC. And part of the reason why is there is an argument that multiples should be higher if companies can be much more efficient and are going to grow significantly more because of some of the technological advancements that are underpinning this. And that's the reason why this week is so important with what we get from Apple and Amazon and Meta and Microsoft, given the fact that they are driving a lot of the adaption and the agents and all of the AI innovation that we're seeing throughout corporate America.
You're on Team Tech, not Team Data, aren't you?
100%, because I think that has been driving a lot of the optimism. Team Data has been just basically a lost cause trying to interpret. You can interpret however you want, and I will say that you're probably right if you look at it that way, and you could look at it a different way, but it has been a Rorschach test.
The gains continue this morning, up by 0.3% on the S&P. In just a moment, we'll catch up with Mike Wilson of Morgan Stanley following a fresh record high. Mike Wilson leaning into the bull case over at Morgan Stanley. More from him in about 10 minutes' time. We'll also speak to the former trade representative Susan Schwab. Look out for that and what's next for U.S. trade talks. And Dominic Rizzo of T. Rowe Price ahead of Mag 7 earnings through this week. We begin this hour with our top story. A city in shock. A gunman taking 4 lives in a shooting at an office tower in Midtown Manhattan.
5 innocent people shot tonight. We lost 4 souls to another senseless act of gun violence, including a member of the New York City Police Department, Officer Islam. No words can describe this act of evil, a man who takes the life of others who are innocent. It's unimaginable to experience a loss of this magnitude.
Joining us now at the scene is Bloomberg's Miles Miller. Miles, thank you for making time for us this morning. I know you've been tracking this story all night, piecing together just what happened. What's the latest?
Yeah, what we are learning this morning is that the suspect was targeting the NFL. It is headquartered here on the 5th floor of this building, 345 Park Avenue, that also happens to house Blackstone, as you can see behind me, and KPMG, as well as some other firms. What we know yesterday is that around 6:28, this man pulls up outside this building with an M4 rifle, a long gun, and immediately starts firing into this building. Behind me, there is a glass panel that is completely shot out here, and it's got the webbing and all of that shows you just how serious this situation was. He fires into the building, immediately strikes an NYPD officer that's doing a paid detail unit, basically an officer off duty, but wearing a security vest and his uniform. What we know this morning is that his motive appears to be targeted at the NFL. He says that he played football in high school and later on, and that he has what is known as CTE. It's a chronic condition, a brain condition that is only really realized after someone dies, when they pull their brain out and really examine it. It is something that has caused and led to a number of deaths of football players. And he says that the NFL had not done anything to do more about awareness about that. We heard from the NFL commissioner this morning by statement. He said that one of the NFL employees was one of the victims in this, is at the hospital now, was shot and was critically injured, but is expected to survive. He also said they're going to be adding more security here at 345 Park Avenue to keep their staff safe, and he's also keeping the staff home today.
Miles, there's a real question about how somebody could be walking in plain daylight with a massive rifle and not be noticed or stopped. What are you hearing about from law enforcement in terms of how long he was tracked walking in the open during the day with a massive weapon?
Driving to the scene this morning, I passed by a precinct that's only 2 blocks away. But there's very little you can do to stop someone with a long rifle, an M4, an AK, any of those kind of things, if you just have a handgun. And the cop who was in this building, along with the other cop, all they were armed with were handguns. So there is going to be a call for the NYPD to start re-employing those specialized units, Strategic Response Group, Critical Response Command, 2 anti-terrorism groups that travel around the city to high target areas to make sure that everything is okay. This really came to the forefront after the shooting death of Brian Thompson, and that happened, of course, just 5 blocks away from here in December. Head of United Healthcare's insurance group shot in the middle of Midtown Manhattan early in the morning, and that is what caused a lot of folks in the corporate world to start bolstering their security. And then you see what happened here yesterday.
Miles Miller with the latest at the scene. Miles, thank you, sir. Let's extend the conversation with the former FBI Executive Officer Michael King, who joins us now for more. Michael, welcome to the programme, sir. You've got 2 decades plus experience with the NYPD. For those not familiar with the process, can you describe the process for us, what took place overnight, what the NYPD will be doing right now?
So thank you for having me, and my condolences to the families of all involved. Right now, the investigation should involve trying to nail down exactly where this shooter came from, his motives. Does he have a manifesto? They have to now do video canvases to go backwards, trying to find out what direction he came from. I heard he drove in from Vegas, which is about 2,500 miles, about a 40-hour drive. So this is a very dedicated person in what he wanted to do. They have to go into his life, dig deep into his life. They have to go into his social media, his friends. I was told a vehicle that he drove here has been commandeered by the NYPD. That vehicle has to be forensically evaluated. They have to take that vehicle and search it for evidence, of course, look for any documents that he left in there, any notes, anything he wrote down regarding what had happened. Another thing that would be great would be to do fingerprints and DNA swabs inside that vehicle, trying to find out who else was in this vehicle with them, because we still have to nail down, is this a one-off, this is a random event, is this one person doing this by himself, or are there other people involved? So you really have to now dig deep into his life, because you can't interview him, you can't interrogate him. You now have to go into all his phones, his computers, anything that he has that's digital. You have to try to find out, do phone forensics, computer forensics, trying to find out what information you can find on this person.
Michael, one theme we've been exploring throughout this morning is the shifting nature of threats. In your extensive terrorism attack response experience, can you talk to us about how the nature of threats is developing, particularly over the last 12 months, with grievances going to corporations and the individuals that represent them, and unfortunately, tragically, having deadly consequences? Michael, what can we do? What do we need to rethink to protect these corporations and the securities and the people that ultimately are employed by them?
So that's a great question. Someone like this who we believe to be a lone wolf, this is your greatest threat. This is someone who's sitting in a basement somewhere. He's off the radar. There's no chatter about him. Law enforcement does not know about him. When you look at his background, you see that he has very minimal. There's not much, no arrests, nothing. Someone like this, to protect against someone like this is very, very difficult. Corporations, companies, what they have to do is double down on not only their physical security, but their cybersecurity as well. They have to have their buildings protected, increase the amount of staff they have in security, because again, when you have someone who's plotting online, they're talking to other people, they're talking to friends, family, maybe mental health issues. Someone makes a phone call to 911 saying, hey, you got to look at this guy. When you have someone sitting in the basement, quietly plotting, they're not online, they're not speaking to anyone, this is your greatest lone wolf threat.
Michael, there's a question about the terrorist threat changing from some sort of group activity to the lone wolf. But to build on what John was asking, there's also this idea of mass casualty events in public gatherings versus targeting specific corporations with specific grievances. How much are you seeing that becoming a trend, or are we just taking it a step too far after 2 incidents?
So you have 2 incidents, and I think what we have here is not something that's systemic. Right now, you have the 2 incidents with the CEO killing and now this. And these are people who have specific grievances regarding specific companies, not something that is more generalized to say, well, we have someone going out randomly choosing whatever company they find. They just step out of their vehicle with a gun and just randomly start shooting. These are people who have specific grievances. So I think when you look at it that way, the threat is minimalized, it's contained to just someone who has that particular grievance, and not say someone who's radicalized, someone who's acting or inspired by a group like ISIS or Al-Qaeda, going out there just trying to shoot and stab or run amok within Times Square. When you look at the weapon that he had, he could have gone to any high traffic location in New York and started shooting. If he was 42nd Street, Union Square, a lot of victims. A gun like that can kill a lot of people in a few seconds. This is something very specific, something very targeted.
Why did this person have access to a gun like that, especially given the fact that he had a mental health history and was even, I believe, accused in one particular crime a while back? I mean, how come somebody can legally have access to a weapon of this power?
Now, that's a great question. Someone with a mental health history. Now, the thing is, do we know that his mental health history was pronounced and that it was something that was known, or was it something that he was diagnosed, but it was not made aware to law enforcement? To my understanding, he had a gun permit issued by Las Vegas PD. So in issuing a gun permit, you would do a background check on someone that would include, is this person a criminal? Does this person have a mental health issue? For some reason, this man fell through the cracks. His background did not show any red flags. And in a state where you're able to purchase a weapon of this capacity without any problems, any issues, very, very easily, therein lies the problem. Access to weapons of mass destruction like this, a weapon like this that is used in war, is used by the military, should not be given or sold to civilians. Because again, the only reason you could have a weapon like this is to kill people.
Michael King, appreciate your time, sir. The former FBI executive officer Michael King there. Every single organization in Midtown Manhattan and around this country needs to completely rethink security protocol. Especially if people have access to military-grade weapons and potentially could come in. How do you protect against that with a traditional kind of handgun and screening system where people badge in and have some sort of semblance of civilization? We'll have updates for you throughout this morning right here on Bloomberg TV with an update on stories worldwide this morning, including our top story. With your Bloomberg Brief, here's Yahira. Hey, Yahira.
Exactly, John. A gunman went on a rampage in a Manhattan office tower housing the NFL and Blackstone on Monday, killing 4 people before killing himself. The gunman was targeting the NFL headquarters, but ended up on the wrong floor. Police say the suspect had a history of mental illness and believed he had driven cross-country to New York. Meanwhile, UPS shares are falling 4.25% in the pre-market after it pulled its guidance, citing macroeconomic uncertainty. This after the company reported mixed results in its last quarter, with its EPS narrowly missing Wall Street estimates, but its package revenue was better than expected. The company is focusing on shipping fewer high-margin packages and cutting back on less profitable deliveries. And Waymo is partnering with Avis to launch a robo-taxi service in Dallas next year. Customers will be able to order rides on Waymo's app, while Avis will provide car management services like infrastructure and maintenance. Waymo has been aggressively expanding, more than doubling its service area in Austin, Texas. as it faces competition from Tesla. That's your Bloomberg Brief. John?
Yahaira, thank you. More from Yahaira in about 30 minutes. Up next on the program, extending talks with China.
The president's going to decide, look, this is how I want to play it. He may entertain a few more deals, or he may decide, you know what, I'm just going to set the policy going forward. But by the end of this week, they will all be set, they will all be in stone, and they will be written.
We've got some clarity, and a lot of people are getting a lot more bullish. Mike Wilson of Morgan Stanley, up next. Live from New York City, welcome back to the program. The gains continue, up another 0.25% on the S&P 500. 6 consecutive days of gains, another all-time high. On the Nasdaq, up by 0.5. Under surveillance this morning, extending talks with China.
The president's going to decide, look, this is how I want to play it. He may entertain a few more deals, or he may decide, you know what, I'm just going to set the policy going forward. But by the end of this week, they will all be set. They will all be in stone, and they will be written, and we will start collecting those additional monies. Right now, we're collecting 10% from everybody in the world, and of course, a higher rate from China. But come next week, off we go.
Here's the latest this morning. Trade talks between the U.S. and China stretching into a second day as President Trump's Friday deadline approaches. The Commerce Secretary Howard Lutnick saying a 90-day truce extension with China is likely. Mike Wilson of Morgan Stanley is bullish, writing, "We're bullish into 26. Through the near term, setup is not without risks. These include tariff-related inflation." Mike joins us now for more. Mike, good morning. Good to see you. You list a lot of reasons to be constructive here. Just go through those reasons for us this morning.
Yeah, I mean, the reasons really haven't changed. I mean, we've been very constructive since May when we did our mid-year update. And I think the main thing to take away from our outlook that's maybe different than others, I think we came into the year feeling the first half would be tricky, second half would be better. And that was all a function of the sequencing of the policy, right? So the policy sequencing was what we said. It's a kitchen sink the first quarter. They did the growth negative stuff first, and then it flipped very quickly in April. So the main reason we're bullish, okay, is that the earnings revision breadth, and we show this every week in our note, and it goes up every week, has exploded higher off of what was, a deep cyclical low that basically priced in a recession for the most part. So that revision breadth is guiding us to the performance that we've seen. This is, just to put it in context, okay, this increase or V-shaped recovery in earnings revision breadth is as significant as we've seen since COVID, the COVID recovery. And that was the last time that we were this far out of consensus being bullish, and it was right because of it's the data. We're data dependent. So that's the main reason. So this is not just me saying, oh, momentum in stocks and price momentum, et cetera. That's part of it too. So what's driving that earnings revision breadth? Well, first, it's the reflexivity just on people getting too bearish on the growth negative stuff. And let's not forget the AI CapEx cycle, which we came into the year feeling negative about, also bottomed in April. Okay, so those are two big drivers. The second one is a weaker dollar. Okay, weaker dollar is a big tailwind for multinational companies. Okay, and the third one now is we're starting to see operating leverage in more companies across the S&P 500. And this is a very unique view that we've had. So you know the rolling recession call that we've kind of been talking about. Well, now it looks to us like we're having a rolling recovery. Okay, and that will be further spurred by the Fed cutting rates at some point in the next year. Now, we don't know exactly when they're going to start, but I think it's fair to say that they're not going to be raising rates. So this 3-year, what I would call soft recession that we've been living through now, we're sort of coming through that. And we're getting more visibility on that. That's why we're more constructive on the next year. Now, in the next 3 months, I do think that some of the things that people have been worried about could start to play through earnings. For example, we could see cost of goods sold increase because of the tariff. The inventory now is flowing through the cost of goods sold. We could see the back end of the Treasury market start to back up again because of the supply that we know is coming. And then, of course, we still have to deal with just the sort of concern around inflation and how does that play through and how does the Fed respond to that. So there are risks out there. We're not saying there's no risks. And remember, the market trades 6 months in advance. So that's what's happened. The market has figured this out. It's gotten ahead of it, and we've priced a lot of good news.
How much is this entirely tech-driven versus a broad-based kind of revisions, increase, and recovery, given some of the mixed guidance that we're getting this morning from a number of companies, particularly those that are consumer-facing?
That's right. Well, it still remains mixed because we're still in this rolling recovery, right? So it's not everything at once. Tech and the Mag 7 are leading, but we're seeing also other groups, industrials, financials, okay, software, which has been in a soft recession for the last couple of years. We are seeing a broadening out for the Mag 7. So it's not where we need to be to say, oh, we're going to move into small cap stocks, we're going to move into the low quality parts of the market. We're still staying up that curve. However, it's starting to progress, just like the rolling recession saw a degradation that was kind of not all at once, but kind of more piecemeal.
So during the rolling recession, we saw gains of about 20% on the S&P 500 for a couple consecutive years. Could you see gains of 20% or more during a rolling recovery? Does it matter if you're in a rolling recession or rolling recovery in terms of the returns?
What I would hope is that we would see areas that have been lagging start to participate more. And that's sort of our view on 26, right? And that's sort of starting to happen now. I mean, industrials has been the best performing sector year to date. It's been our top pick for the right reasons, for the reasons that we've been citing, which is earnings there are starting to look better. And let's not forget the tax bill, which I didn't even mention earlier. This is a massive, tailwind for cash earnings for U.S. companies. I mean, to the tune of 5 to 10% increase. So that's real money going into the pockets of companies. They're now allocating capital, not the government. And I think everybody would agree that that's probably a better outcome.
Do you think U.S. exceptionalism is back? Is everyone else signing up to that?
Well, what I would say is that maybe U.S. exceptionalism has been missing. Okay, so now, I mean, no one wants to admit this, but the direction we're going in now, it looks like we are going to see better participation across the economy. We've been waiting for this. We've been waiting for this for 2 or 3 years. You know, we've been kind of back and forth, sometimes bullish, sometimes bearish, trying to pick stocks. And this is the first time I can say that I can now see the path of this transition where we're actually starting to rotate into more of an early cycle recovery.
Let me give you some more space to do this because it's important. The strategy of the White House and the rebalancing that you envision a year out, 2 years out, 3 years out, what is it you see?
Well, the rebalancing is both global and domestic. So the global rebalancing is obvious. They're trying to reduce our current account deficit, get the trade negotiations are along those lines. And I think that's right. I think that's a good strategy, getting more manufacturing potentially in-house or domestically. In the domestic rebalancing, it's really, instead of just having the 1%, right, it's, Main Street over Wall Street. I mean, people say, well, that doesn't sound like that's working right now. But the idea here is you get lending through the regional banking sector. You get lending, smaller banks, lending to small businesses, to individuals, get rates down at the back end. Okay, that will liberate actually the domestic, the sort of the middle part of the economy.
Where do you then place this idea that tariffs are pretty regressive? This idea that lower income individuals bear the brunt of it because it's essentially a sales tax on them, and you're already seeing companies really grapple with what that means for demand, particularly in the travel and leisure space. How do you square that with the sort of broad-based dynamism that you're talking about?
So I think it's very simple in the sense that you have to think, what do you have to think about? What are the tariffs trying to achieve? My view has always been that this is going to end up being an import tax. Now, I would have said, 2 weeks ago, this is a 10%, it's going to end up at a 10% import tax that's going to be shared between exporter, importer, and consumer. And the market will determine, who can absorb those tariffs. Exporter will decide, hey, we got a discount because we're going to lose volume. Importer will say we can't pass it on, we're going to eat some of that. And the companies that have pricing power will pass it through. Now we believe that the consumer areas have less pricing power. So I would argue that the pricing power is going to be more probably in the industrial space, probably more in the, sort of the value-added supply chain. So then what do they do on the other side? Oh, they do a tax cut for the companies. So it's just basically saying we're going to tax this chain here, which is going to be a shared tax, but then we're going to actually give that away to corporations who can then reinvest and actually get the economy moving. It is a capitalist type of approach. Now, I don't know if it's going to work perfectly, but I like the direction of it. From an investor standpoint, I love this. Now, I'm not here to make judgments about who gets hurt the most or whatever, and I don't really know, but I can see the path and why we're more constructive, why we've been more constructive on the 12-month view. I think, remember last year you said, Mike, this is the first time I've heard you sound a little more constructive, because I had that vision.
It's overwhelming this morning, Mike. I've got to get to a break. We all need a break. Mike Wilson of Morgan Stanley. Mike, appreciate it. Thank you, sir. It's good to see you. Up next, the trade conversation continues. Mike Wilson of Morgan Stanley on with us just moments ago, leaning into the bull case 7,200 on the S&P 500, over the next 12 months. He's not alone. The gains continue. Equity futures up this morning by 0.25% on the S&P, following 6 days of gains and looking for day 7. On the Nasdaq 100, higher by 0.4. We're 2 hours away from the cash open. Let's get you some morning movers. Here's Danny Berger with more. Hey, Danny.
Hey, John, some more earnings over the past hour. The big one out of Europe. I have the U.S. ADRs up, but it is Novo Nordisk. You'll see something similar in the European trade, too. Down 16.8%, nearing 17% this morning. It has cut its sales guidance, a surprise to this market. Now, Novo Nordisk has been struggling. A lot of competition for its weight loss drugs. Wegovy sales have been weaker than expected. It hasn't ousted its CEO, so the troubles continue there. We also had some more earnings this morning, this time coming from another drug company, that is Merck. An issue there, narrowing their full year guidance to. The problem for them is that their key drug, Keytruda, is going to be coming up for generic soon. So they need a rush and change strategy. So they're cutting about $3 billion worth of costs. They're going to be firing employees. They're going to be reducing their real estate. They say they're going to reinvest that into looking for new drugs. Also an issue with Gardasil sales in China. So those shares falling 3.5% to the upside this morning, though. We also heard from JetBlue. The loss was lower than expected. They say demand is coming back. Their strategy of reworking things, cutting unprofitable routes, that it is paying off for them. They're also saying they're seeing a lot of demand about 2 weeks out from when people are flying. The president of JetBlue saying that they are confident demand will continue at pace into the second half of the year. Those shares up 1.8%, John.
Danny, thank you. Appreciate the update. Thank you very much. Boeing just crossing just moments ago. We'll come to that in just a moment. We'll catch up with Brooke Sutherland in a couple of moments' time. Just want to get you an update on our top stories worldwide. On our radar this morning, a gunman fatally shooting 4 people in a Midtown Manhattan office building on Monday evening. NYPD identifying the shooter as a 27-year-old man who drove to New York from Nevada. Elsewhere, the European Union's trade deal with the US is facing backlash from European leaders. The French Prime Minister calling it a dark day, and the French Minister for European Affairs saying the deal cannot be sustainable.
At a time when this is what you were expecting yesterday, and you raised this point, this is what you have when you get a European Union that's trying to collectively decide exactly what a trade agreement is going to look like at a time where there aren't a lot of good options with President Trump. We said yesterday that the currency market was making the argument for us that the U.S. got the better deal. And now there are a number of different sectors as well as leaders who are kind of waking up to the at least popular realization that that's what's
2 weeks ago, we were surprised they'd accept 10%. 2 weeks later, they've accepted 15% and said thank you afterwards. It's kind of shocking what took place over the weekend.
And it's pretty shocking that initially a couple of the European auto manufacturers saw their share prices pop. And then they fell dramatically as people started to think about what this could mean for them in terms of reduced income. So, again, people trying to figure out who got the better end of the deal and what this actually means for trade.
You're thinking of Stellantis, so let's talk about Stellantis, revealing it expects to take a $1.7 billion hit from tariffs this year. The new CEO sharing the automaker will, quote, continue making the tough decisions needed to re-establish profitable growth. That stock, as you said, is down this morning by close to 4%.
Yeah, and Jeffries was saying that their guidance that they did reinstate was incredibly vague. And one of the key vague points was not necessarily the Europeans and the U.S., even though it's a European company. It was Mexico. And this idea that we're not done. We have a lot more in terms of tariff negotiations that are coming down the pike, including Mexico, which has been one of the main manufacturing hubs and backdoors into the United States from other countries, from China to the Europeans. And it remains to be seen what that looks like.
Totally with you. I think most of us would argue they're the 2 biggest pieces of the puzzle. The US, Mexico, Canada, and renegotiating USMCA over the next 12 months. That is going to be a huge effort to undertake.
Especially given how much supply chains have rejiggered since some of the tensions between China and the U.S. to Mexico in particular. You have to also wonder if President Trump is going to renegotiate USMCA, which he negotiated to the first place during his first term. It also raises a question, as you were saying earlier, how binding are some of these agreements?
Big questions for the future of trade. Big questions for the future of Boeing as well. Let's turn to those earnings I mentioned just moments ago. Joining us now is Bloomberg's Brooke Sutherland with more. That stock is up by 2%. Brooke, what's the latest?
I think that this was a really strong quarter for Boeing, and one of the strongest that they've had for quite some time, just given all of the challenges that this company has. You saw a really positive surprise on cash flow, which just reflects the pace of deliveries that the company was able to pull off this past quarter. Production on the 737 is finally at that key 38 per month rate. That is the limit that the FAA had set in terms of how many planes Boeing could put out a month until the FAA was satisfied with its factory processes. And so now sort of the key thing to watch is going to be, does the FAA lift that limit and allow Boeing to ramp up deliveries further and improve that cash flow number even more?
Do we have a sense, Brooke, of how much this is stemming from some of the trade agreements that we've seen internationally, where Boeing seems to be part and parcel of them in terms of purchases of airplanes from the United States rather than, say, a European competitor that rhymes with Airbus?
That is definitely a big thing here. And, it's funny because in the first trade war, Boeing was really complained about being a pawn between the U.S. and China, because you saw China halt deliveries as a way of, increasing its leverage over the U.S. And now you've really seen the reverse, where so many different countries are looking to Boeing jets as a way of sort of reducing that trade deficit, improving that trade relationship with the U.S. This is one of our highest value exports. And I think countries are cognizant of that, you buy a couple of planes, rack up a couple $100 million, that goes a long way, especially in the mind of President Trump when he's negotiating these trade deals.
Brooke, appreciate your time. Stock is higher by 2.5%. Who were you thinking about?
That rhymes with Airbus.
Airbus.
Well, it was really bad rhyme. Sorry, I apologize.
Let's keep it on trade. The backlash against Europe's trade agreement brewing across the continent after striking a trade deal with the United States. Joining us now, someone with extensive experience of all of this, the former Bush trade representative, Susan Schwab. Susan, good morning. It's good to see you.
Good to be here.
Let's talk about how much things have changed over the past few decades. How surprised are you about where we are compared to where we were?
Well, it has been a dramatic change. Obviously, it started during the first Trump administration and continued through the Biden administration, because that was sort of a moribund trade policy. Nothing happened, really, for all intents and purposes. And then the second Trump term is very different from the first Trump term. I mean, including what appears to be a dramatic, potentially dramatic change in the USMCA, terms of the USMCA, which is going to have a major impact in a lot of how the supply chains are designed. In fact, a lot of companies took their leads in terms of where they were producing, where they were sourcing from in their supply chains from the first Trump term and the focus and the target of China. So production moved to Vietnam, moved to Malaysia, moved to other countries. And now the focus is on bilateral trade deficits, bilateral trade deficits, bilateral trade deficits. And that's changed the focus. I focus more on the trade plus the macro side. This administration is less concerned about, or seems less focused on the macro side, the deficit, like the macro deficit, as distinct from the trade deficit. But that's their focus. And
hold on a second. Sorry to interrupt, but this is actually something that a lot of people have brought up, including Mike Wilson and Peter Tchir, saying that actually these revenues coming from the tariffs do offset the trade deficit. And from the macro perspective, what you're seeing the stock market say is that companies can adapt and adjust to a lot of these tariffs and pass it along, or else absorb it on their bottom line. What are you seeing that makes you question that?
Oh, I think that these are tax. Definitely, these are a tax, and the tax is going to go into the coffers of the Treasury. Question is, who's paying the tax? Most of that tax ultimately is going to be paid by the consumer. And how much tax is being collected? And the answer is a fraction of what we're running up in the way of the federal debt and what we have in place in the federal debt deficit. So if you think about the most dramatic estimates that are out there, let's say you're looking at the $300 billion a year number, that is a drop in the bucket compared to what we're spending annually and what the projection is. So yes, it is a contribution. And how are you making up that contribution? You're taxing your citizens.
A lot of people have looked at this as, in some ways, a win for President Trump, given particularly how high of a rate the U.S. secured with Europe after talking previously about a 10% rate. What are you seeing in the negotiations and the terms that we're hearing, albeit somewhat rough, that gives you a sense of whether there is a winner, whether there is a loser, or what your questions are going forward?
Well, the winner and loser question is a really great question. I think that the winner-loser is uneven, first of all, and you can't totally assess it because as you implied, there's going to be a change in exchange rates that will adjust somewhat that 15%. Then you're going to have the tariff, the tax, split between the exporter, the importer, the ultimate consumer. I mean, we know more than a third of what we import goes to an intermediate consumer, right? So it's a manufacturer that is importing steel, aluminum. They're paying 50% more than what they were paying before. And under the radar, something that a lot of people aren't looking at are the 232, quote, derivatives, right? So derivatives, hundreds. At the moment, they're pending 45 product requests to raise tariffs by 25% on steel and aluminum derivatives. We know that, cans with beer in them are already there, but cans that have aerosol, anything that comes in an aerosol can, that's on the table potentially for tariff increases. That did not exist in the first Trump administration. The derivatives of all of these, copper, aluminum, steel, and then you've got all of the other Section 232 cases coming down the pipe, auto parts, and so on. So you've got auto parts, you've got pharmaceuticals coming down the pipe, so on. So that will impact consumers who clearly are losers, right? If you're buying a car, if you're building a house, if you're trying to outfit a house, if you are right now consumer goods, getting your kid ready for school this fall, those are very, very specific examples. In terms of, quote, inflation, the overall, calculation, because that's a technical calculation, that may or may not show up in the near term. It's starting to show up a little bit. I don't think, given the volatility, I think retailers are doing everything they can not to push that through to consumers. At some point, they won't be able to hold off anymore. Let's say, third quarter. I'm not sure. It depends on the retailer, or it shows up in earnings.
That's why the core of the Federal Reserve is in wait-and-see mode, and we're about to hear the same thing again tomorrow afternoon.
Because ultimately, we don't know how much there is going to be some sort of inflationary impact, and right now, we're not seeing a real reason for them to cut rates in terms of the labor market. So that's their justification, even despite the fact that we heard from President Trump yesterday. Well, they're going to cut rates. They should.
Eventually, maybe at some point, but we don't know. Susan, can I finish with you just on China and your experience of dealing with China? And the push at the moment to get them to rebalance is not new. This has been going on for decades. Why are we finding it so difficult when most people assume also they agree it's good for them? Why don't they seem to get it? Why is this becoming such a big challenge?
It's always been a big challenge. I think we needed to take a hard line with China earlier on than we did. We needed to force them to play by the rules earlier than we did. I think this administration has underestimated or overestimated, let's say, put it that way, the leverage that the U.S. market represented in their negotiations. And the Chinese, they have their own politics. They have their internal politics, and it's hard making tough decisions. And their tough decisions in terms of generating more domestic demand are harder than stimulating exports. And their overcapacity problem, quite frankly, is an economic mistake. And they are, year in and year out, exporting their economic mistakes, and the rest of us are paying for it. And so one of the interesting things in the negotiations that the administration is doing with other countries that we don't know any details of these deals, right? There's only one that's been signed. We've got some social media posts. We've got some White House announcements. One of the interesting things that pops up is how some of our key trading partners are going to treat their imports of overcapacity products from countries, unnamed countries. That will be very interesting. Obviously, we want to prevent transshipment. That is the key in terms of the negotiation with Mexico.
Yep.
So I think that's a very, very, potentially very important element of what the administration is trying to do. But in the meantime, China China plays hardball with everybody, and they're clearly playing hardball with us. And I'm not sure we're taking as hard a line with them as we could.
Interesting. Susan, got to leave it there. It's good to see you. Thanks for dropping by. Thank you very much. Susan Schwab there, a former Bush trade representative, with an update on stories elsewhere this morning with some of our top stories worldwide with our Bloomberg Brief. Here is Yahara Arnott. Hey, Yahara.
Hi, John. A gunman opened fire inside a Manhattan office tower housing the NFL and Blackstone, killing 4 people before killing himself. Authorities say he intended to target the NFL, but ended up on the wrong floor. A manifesto found on him and social media posts reveal an obsession with CTE and anger toward the NFL over how it handles head injuries. Meanwhile, Boeing shares are rising 2.5% in the pre-market after the plane maker beat estimates on revenue and reported smaller than expected losses for the second quarter. The U.S. jet maker also won more orders so far this year than rival Airbus, its European rival, delivering 280 aircraft in the first half, the most in that time frame since 2018. Boeing showing signs of stabilization, but you can't say the same for Novo Nordisk. Those shares are plunging, down 26% after it lowered its financial forecast in an unscheduled update. The drug maker slashed its sales and profit outlook, blaming slower demand for its key weight loss drug Wegovy. While Novo did say a new contract with CVS would help drive volume starting July 1st, it's still facing pressure from Eli Lilly's rival drug, Zepbound. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Up next on the program, the big question for big tech.
It is about tech, and I think it's something to keep an eye on. The question of whether, the CapEx spend, whether that goes into earnings and ROE, right? And that's the big question out there. That's what's been driving the markets really for the last decade, the last 15 years.
Up next, Dominic Rizzo of T. Rowe Price from New York City. You're watching Bloomberg TV. Up in about a few hours away. Equity futures doing okay, positive by 0.2% on the S&P, on the Nasdaq 100 up by 0.4. Under surveillance this morning, the big question for big tech.
It is about tech, and I think it's something to keep an eye on. The question of whether, the CapEx spend, whether that goes into earnings and ROE, right? And that's the big question out there. I think for the market, that question must be answered in the positive. Otherwise, there is risk in the S&P here. That's what's been driving the markets really for the last decade, the last 15 years.
It's the latest this morning. Investors looking for returns on big tech spending on AI. Meta and Microsoft reporting tomorrow. Apple, Amazon on Thursday. Dominic Rizzo of T. Rowe Price writing the White House AI action plan and the big beautiful bill is going to supercharge the spending environment. Expect big capex numbers out of Microsoft, Amazon, and Meta. Dominic joins us now for more. Dominic, welcome to the program. Can we put some numbers on big? Just how big and how tolerant are investors going to be of those investments?
First off, great to see you guys. Thanks for having me. Look, let's take a look at what's happening in technology so far this earnings season. It's really a tale of two cities, right? If you're tied to AI, everything has been incredibly strong. If you've been tied to anything else, smartphone, PCs, auto, industrial, frankly, it's been quite tepid. And I think Google's a really good example of what we may see in the Microsoft and the Amazon and Meta prints. Let's look at those Google numbers. Google Cloud grew 32% year over year in the quarter. Google Cloud Platform probably grew closer to 37 or 38%. And they took their CapEx numbers up $10 billion from $75 billion to $85 billion. That represents 65% year over year growth. And despite all this, they're still going to generate $70 billion of free cash flow. So when I look at what's probably going to happen out of the likes of Meta, Amazon, and Microsoft this quarter, I think we're going to see some pretty big CapEx numbers. I think we're on a path to $100 billion at Microsoft. I think we're on a path to over $100 billion at Amazon. We're probably on a path to $80 billion at Meta. And I do think that these companies are getting high ROE on this spend.
Dominic, do you think shareholders will reward this type of spending plan, or do you think that they're going to penalize it, as they did a couple of months ago?
Well, I think it really comes down to, are you seeing the revenue growth that goes with that CapEx growth, right? And so, like I said, at Google, we definitely saw that in those Google Cloud numbers. At Meta, I mean, the question is, are we going to see 18% top line growth? That definitely justifies this level of CapEx spend. At Azure, at Microsoft, are we going to see closer to 36, 37% growth or 33? My gut is we're going to be north of 35% on Azure. And at AWS, are we going to see 18, 19% growth or 16? And I think we're going to be closer to 18, 19. So you put it all together, I think investors will reward it. But frankly speaking, who's the winner in all of this, right? It's the chip companies. It's the NVIDIAs, AMDs, and Broadcoms of the world.
Dominic, at what point do the weaker hands get that much weaker as the stronger hands invest more and more? And I'm thinking, for example, of Apple, not to mention Tesla, some of the biggest losers when it comes to share price so far this year. How much does that just get exacerbated by the ability and willingness to spend on the part of the really stronger hands?
Well, I actually think those are two pretty different stories. So Apple is tied to smartphones, right? And upgrade rates at smartphones are at record lows. What we've seen at the likes of T-Mobile, Verizon, AT&T last quarter is, frankly speaking, people are just not upgrading their phones. And why would they, right? There's really no reason to right now because Apple Intelligence is not adding any dramatic more value in your day-to-day life. So I expect tepid growth on the smartphone side out of Apple. Let's see if they can make a big capital allocation decision that can get them out of this problem. Let's not forget, this is still one of the companies with one of the largest cash flow balances in the whole world, and they can use that cash to go do something productive, like maybe partner with Anthropic and pay up to have a nice large language model behind Siri, or buy someone like a Perplexity. So let's see what ends up happening there. At Tesla, I think it's actually quite a different story. What's happening with Tesla right now is there's just a lot of uncertainty around big purchases, and interest rates are relatively high. So I actually think Tesla is quite ahead in the AI race, whether it comes to full autonomous driving or whether it comes to partnerships with things like Elon's Grok, which has a very, very strong large language model. So I think that's a little bit different than the Apple story, but I think you're hitting on a very important point, which is the AI strategy at all of these companies is the most important thing for all of these management teams.
Dom, just a final question on Apple. You said wait and see. Do you want to hold a stock in a portfolio if your view at the moment is wait and see?
Well, what I'm trying to do across all my strategies is create an all-weather technology strategy, right? Trying to capture the upside and blunt the downside of, frankly speaking, what could end up becoming quite a speculative market, right? I think AI has the potential to be the biggest productivity enhancer for the global economy since electricity. Productivity-enhancing technologies come with speculative bubbles. How do you navigate those responsibly, right? And so if you look how I try to do it with Apple, I'm underweighted in the strategy, but it is also quite a durable name. It has quite good upside-downside capture. So you have to think about how underweight you actually want to go.
Dom Rizzo, appreciate the input. Thank you, sir. Dominic Rizzo there of T. Rowe Price, looking ahead to some big earnings still to come over the next few days.
Yeah, the tale of two cities has been reflected very much in just share performance so far this year. I am curious about how much you are going to see a reversal of some of the concepts that people were talking about where spending is a good thing and it's rewarded by the market, at least plans for CapEx from the likes of Amazon and Microsoft.
Depends who you are, right?
Exactly.
Meta, apparently, it's great. Hundreds and hundreds of millions of dollars on employment contracts.
Yeah, but that's exactly the point. How much do they get that much stronger? Because they have that kind of money that they can invest in talent and take that talent from the weaker hands, i.e. Apple. And how much of an upper hand does that give them when it comes to the next leg of AI?
They are behaving like they're facing an existential risk. We'll talk more about that in the next hour. Coming up, Kevin Gordon of Charles Schwab, Zach Waring of CFRA, Stephen Stanley of Santander looking for zero on payrolls Friday. Don't miss that. And the new biggest bull on Wall Street, John Stoltzfus of Oppenheimer. He joins us next.
There's just a lot going on, I think, in a positive way.
A lot of the uncertainty that was prevalent earlier in the year is really being washed out of the system right now.
Yes, you might see a slowdown in economic growth, but you're still seeing really resilient results from companies.
The AI theme has kicked back in.
The market's just in a particularly joyous place right now going into August.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The opening bell 90 minutes away. Equity futures positive by 0.25% on the S&P. On the Nasdaq 100 up by 0.5. All-time highs coming into Tuesday as the Fed's two-day meeting begins. Concludes tomorrow on Wednesday. Data on Friday. Payrolls just around the corner. And in between, lots of earnings. Through Wednesday and Thursday, four of the biggest names in tech. You'll hear from Meta, Microsoft, Apple and Amazon.
You said earlier the calm before the storm, because we do get so much data and so many earnings for such a huge proportion of the overall U.S. index. But it certainly has been calm, and it could continue to be. We've seen a move of less than 1% for more than a month in the U.S. equity indexes, and it raises the question, is it just a sort of melt up driven by a couple of names, and you have a really bifurcated market that's coming to the fore in all sorts of other places as well? It's a very interesting moment to be really looking at this.
How relevant is tomorrow's meeting for the Federal Reserve and Chairman Powell? Relevant to the White House, I get that, and relevant to all the economists tracking this story. But for equity market participants right now, bullish this market, how relevant is this meeting?
The one relevant aspect is going to be the jockeying for the position for Fed chair next year. Do we have a sense of who is on the slate of potential candidates and what they're willing to say to potentially get the ear of the president? In other words, how politicized will the Fed be, and what kind of rate cutting path are they going to be on in 2026?
Fed Chair Jay Powell coming up tomorrow afternoon. Look out for that news conference and decision and special coverage right here on Bloomberg TV. Equity futures at the moment positive by 0.25% on the S&P 500. Coming up this hour, we'll catch up with Kevin Gordon of Charles Schwab with stocks at all-time highs. Stephen Stanley of Santander looking for zero. Payrolls coming up on Friday, apparently, according to Stephen. Plus, we'll catch up with John Stoltzfus of Oppenheimer with the most bullish forecast on the street for the S&P 500. We begin this hour, though, with our top story. A city in shock. A gunman taking 4 lives in a shooting at an office tower in Midtown Manhattan. Joining us now is Bloomberg's Miles Miller, who has more. Miles, breaking news just moments ago.
And that's right. We just have confirmed the death of a Blackstone executive. Her name is Wesley LaPotner, and well known in corporate circles and also philanthropy. Here at Blackstone, she ran their real estate investment trust and was a part of the executive committee as it relates to investments. Outside of here, had done so much work in the community, on the board of the Met, on the board of the Heschel School, a Jewish day school here in the city, on the board of the UJA Federation, doing so much that she could in the community to make New York a better place. And it is here where she was leaving work when she was shot and killed yesterday. Let's set the scene again. 6:30 about yesterday, guy pulls up in a BMW, pulls out an M4 rifle and starts firing into the headquarters of Blackstone, the headquarters of the NFL and KPMG. He thinks he's making his way upstairs to the NFL offices because he had an axe to grind with the NFL, because he said he had CTE. Meanwhile, he'd never played for the NFL. He made his way up to the Rooted Management Group, which is a REIT here in Manhattan, and that is where he opened fire, shooting another person and then ultimately killing himself. He killed an NYPD officer and shot an NFL employee. We know that Blackstone and the NFL have their employees working from home today, and they are really issuing their condolences in relation to the people who've been killed here, including that Blackstone executive.
Miles Miller with the latest on the scene. Miles, thank you, sir. Just absolutely tragic. It goes without saying that our thoughts are with her family and everyone at Blackstone this morning.
This is an incredibly difficult thing to cover, and I will say that everyone is just hoping, A, for some solace for those families that were affected, but B, for some comfort that this isn't going to happen again, with some questions swirling about why an individual with a history of mental illness had this type of weapon and how we can continue with the security that this will not happen at another in any other place.
In just a moment, we'll cross over to Yahara Anand and get you an update on what's happening on the ground, and any more headlines in between, we'll bring them to you. If you are interested in what's happening with financial markets right now, futures are just about positive by 0.25%, with stocks looking for a 7th all-time high. Kevin Gordon of Charles Schwab has a view. In arguably the biggest economic data week of the year, it all comes down to labour. Solid labour data will matter most for markets. Kevin joins us now for more. Kevin, good morning. It's good to see you.
Nice to see you.
Difficult morning?
Yeah.
Without a doubt. But we'll make some space to talk about financial markets. Let's talk about why the data for you is so important this week when we've got so many earnings elsewhere.
Yeah, well, I think I would wrap earnings in with the broader economic data, especially on the labor front, because the real mechanism that we're looking for and trying to see and assess with trade and tariffs is if any of that starts to take a big bite out of hiring. When you think about companies' largest costs being labor, if that's where they turn to, if they face a significant increase in costs and if that's ultimately what brings the broader labor market to a weaker spot. So far, not the case. And I think even with, the June jobs report, even if you get a reversal in some of those, I'll call them blips that were in there in terms of what accounted for most of the hiring at the state and local level, at the education level, the fact that the unemployment rate went down because you had this significant drop in the labor force, even if some of that unwinds a little bit, you can still be in a pretty solid spot for July. So really it turns to that back half of the year where you start to see, if at all, if there are impacts from tariffs, if they're going to start biting, that's where you really start to see it.
One of the reasons why I've been more excited for earnings than I have been for the economic data is because every time an economic data point comes out, I get 15 different interpretations and people point to different aspects of the numbers to justify why they have those opinions. Why do you feel like we're getting better data from the overall government issued numbers rather than Merck laying off workers today because of efficiencies, a number of big corporations not hiring entry-level staff because they can just get AI to do it?
Well, it's interesting. In some ways, we've sort of seen this movie before, where at least in the post-pandemic cycle, and I was thinking back to, the conversation you guys had with Mike Wilson on the last hour, talking about how, we had the same view around rolling recessions, being in certain pockets of the economy, especially manufacturing versus services over the past several years. Embedded in that were a lot of these sort of idiosyncratic company-specific stories where there were significant layoffs or there were significant cuts to guidance, but that didn't filter through to the broader economy. It didn't really rise up. So to some extent, you're seeing that again now. And I would argue, actually, one of the reasons that we've seen such a sort of incredible recovery in the market is because what's been leading have been industries, not necessarily at the 11 sector level. If you look at the 25 industry level, industries with the strongest margins have been leading. So those are the ones that can probably withstand that tariff shock a lot more, or they're further away from the epicenter of the tariffs. So you think the banks are almost the perfect example of that. And this earnings season, I would almost put the banks and the autos on opposite sides of the spectrum, looking at where the tariff pressure has shown up. You're not really seeing it at all in financials because you probably won't, given its services dominated, but you're definitely seeing it in an area like autos, but that's a small share of the market.
You sound a lot more skeptical than Mike Wilson of Morgan Stanley, who came on and said we had been dealing with a rolling recession for 3 years, and now we seem to be dealing with a rolling recovery, a rolling bull market. Why? Why are you not convinced?
Well, it's not as much that I'm not convinced. I just think that when you listen to what companies have been saying around pricing and what their response is going to be to tariffs in particular and the CapEx slowdown that we have seen, at least in CapEx intentions, even though some of the regional Fed surveys, which is sort of the best gauge that we have right now in terms of where confidence, can be turning on a dime because they come out before the ISM, headline indexes have been improving, but those underlying CapEx components haven't been improving as sharply, and in some cases they've actually been turning lower. And in some ways, this all really comes down to what happens at in the business investment channel, because that tends to drive employment gains, which tends to drive consumer spending, that drives overall productivity. So that's really what we've become most focused on. So it's not that I think that the recovery is completely stunted, because our view from a tariff standpoint, and we have to remember that pre-April 2nd, we were not in a zero tariff world. I mean, the market was still digesting that we were going to get tariffs going up relatively, significantly. So if we're going to go into a tariff world, and what we've been hearing from our clients who are facing this in terms of having small businesses is just tell us what the rate is and don't change it. Tell us what the rules of the game are, and then we'll be able to play. So if you can get past that, which arguably we're coming to that point, whether it's this Friday or not, or August 12th or not, you're getting closer to that point, which I think is a pretty important needle mover for the market and for the economy.
We're in the middle of that process right now. What started before April 2nd, though, was this allocation abroad to international equities. Is that just a moment in time or an ongoing story? How do you feel about European stocks right now following the agreement over the weekend?
I mean, we're relatively constructive because I think, well, first of all, from our perspective from our clients, nearly 40 million people who for many, many years have become very accustomed to just the U.S. dominant trend, really being the ruling trend, for good reason. But I think that when the international versus U.S. or, U.S. versus ex-U.S. argument is often talked about or discussed, it's framed in this context of all or nothing. And it's, just dump U.S. at the expense of everything else. And of course, that's never how this works for any kind of balanced portfolio. So it's really a matter of looking at what has become maybe a little bit of an improved opportunity set relative to what was. So if you're just looking at Europe, for example, relative to what was, yeah, clearly things have improved. Even the internals of the DAX, those have been much stronger this year relative to the S&P. At one point, you got to almost a third of members in that index making a new 52-week high. We have not gotten there on the S&P 500. So there are still relatively healthy internals when you compare it to the U.S., but I wouldn't look at it at all as some sort of all-or-nothing trade.
To be fair to people who have been long exclusive of the US for the last decade, there have been many, many good reasons to have that trade on. I think they still face the same question. When I buy America, I know what I'm buying. When I buy Europe, what do I own? What am I buying?
Well, yeah, the sector bias, I think, is really important there. Because, yeah, when you're in the U.S., I mean, the tech-centric nature of this market now, not just tech, the sector, but tech and tech-adjacent parts of it. I mean, you're getting to half, and in some cases more than half of the index. Plus, tech has become more of this cyclical beast, in addition to being a growth beast as well. So I think that's a really important, certainly has been an important driver of outperformance over the past several years. But when you compare that to Europe, if it's a little bit more financial centric in certain countries, or if it's a little bit more, auto and manufacturing centric, if you don't get that important cyclical upswing, then it's going to be really tough to outperform.
What is it you always say?
Luxury and weight loss.
That's right.
And right now, weight loss is kind of, on the back foot, evidently, with Novo. So
luxury too.
Exactly. So there you go.
Yeah.
Although it's different between Hermes and LVMH. It seems like a totally different situation.
What's gone wrong with luxury?
Yeah, you would know.
Well, it is bifurcated. I mean, I'm not a luxury analyst, but it's
in a way.
Yeah, I think that maybe I'll just leave it at that.
Okay.
I don't know.
Sensible. All right. Keep you out of trouble. Kevin, thank you. It's good to see you. Thank you, sir. Kevin Gordon there of Charles Schwab. Let's give you an update on stories worldwide with our Bloomberg Brief. Here's Yahara Arnott. Hey, Yahara.
Hi, John. Blackstone confirmed one of its employees was among the victims of yesterday's deadly shooting in a Manhattan office tower. A gunman opened fire inside, killing 4 people before taking his own life. Authorities say he intended to target the NFL's headquarters, also in the building, but ended up on the wrong floor. Meanwhile, U.S. Commerce Secretary Howard Lutnick says a 90-day extension of a trade truce with China is likely. Negotiations between the two countries are still underway in Stockholm, with Treasury Secretary Scott Bessent leading talks for the U.S. Key sticking points include fentanyl trafficking and concerns around China purchasing sanctioned oil from Russia and Iran. Meanwhile, take a look at Stellantis shares. They are falling 3.5% in early trading. The automaker shared it expects to take a $1.4 billion hit from tariffs in the second half of this year. This after Stellantis recorded a near $350 million impact from tariffs and lost production in the first half. Shares have been struggling, down over 25% this year. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you very much. More from Yahara in about 30 minutes' time. Up next, the Morning Calls Plus. Zach Waring of CFRA saying retailers will have to share the cost of tariffs with the consumer. That conversation up next.
One thing I think we're missing right now is part of what's driven, I think, there's U.S. stock market return is the weakness in the dollar, right? DXY is down significantly. You look at European, stock markets. For a U.S. dollar investor, they're up significantly more because of that. So I think the weak dollar, if that starts reversing, that will actually put some pressure on U.S. stocks. I do think we're resilient. I think it's about the growth story.
Peter Tchir of Academy Securities, slightly constructive on a range of issues, but he thinks it's too soon to tell the impact of higher tariffs, and he's not alone. We'll have that conversation in just a moment. Equity futures positive by 0.2% on the S&P, on the Nasdaq 100 up by 0.45. That's the price action. Your morning calls look like this. First up, Bank of America raising its price target on AMD to 200, saying it has a comfortable average selling price premium over Intel. Next up, CFRA upgrading Alaska Air to buy, seeing upside potential in its 3-year strategic plan. And finally, RBC raising its price target on Tesla to 325, citing a better than expected robo-taxi launch. That's the latest on Tesla. That stock is up by, or rather down by 0.3%. Elsewhere, we turn to another read on the consumer on deck for 10 a.m. Eastern Time. Bloomberg's Michael McKee joins us now for more. Good morning, Mike.
Good morning, John. Well, you take a look at that chart you just showed, and you can see that consumer confidence has been falling. The question is,
What does that really tell us? We tend to watch what consumers do, not what they say. That's the old Alan Greenspan line, because there isn't a huge correlation between the two. Confidence and spending data only modestly correlated. The fundamentals will tell you pretty much the same thing as the data. The correlation has also weakened since the pandemic. If you're a statistics nerd, basically the R-squared is around 0.3 at this point. So there is some statistical validity, but not a whole lot of predictive power there. People thinking it is easy to get a job has been falling, and that's what really drives the conference board numbers. We'll see what that comes out with today. The problem, of course, is that the jobs report is on Friday, so these numbers come out a little too early for that. But the conference board does track buying intentions, and they have been very mixed. There's been little change in intentions to buy cars, but there are fewer people who say they want to buy homes and more people who say they want to buy appliances. Kind of the interesting question for the numbers that come out today is last month, fewer people said they wanted to buy air conditioners after the heat wave we've seen. That may change in the numbers at 10 o'clock this morning.
Mike, before you go, and it's great to see a summary of what we're expecting, can you give us a sense of the quality of the data and the survey responses and how much there is an increasing estimation of what the numbers should be rather than actual measurement in the U.S. economy?
Well, the Conference Board, obviously, as is the University of Michigan, are private surveys. But in terms of the actual data we're getting these days, we're having more estimation, particularly for consumer prices, where the Bureau of Labor Statistics has to estimate prices in some categories because they don't have enough people now to do the actual surveys. The accuracy is still very strong, but it's not what it was, and they do their best to statistically adjust the numbers. It's just one more problem that the Fed and others face in trying to figure out what's going on with the economy.
Michael McKee, thank you, sir. We'll come back to you a little bit later. Mike, thank you. Let's stick with the consumer. Zach Waring of CFRA writing, the consumer is holding in as long as employment remains stable. Retail hasn't seen the full impact of tariffs yet. Zach joins us now for more. Zach, welcome to the program. Are you suggesting the tariff test is still ahead of us?
Yeah, thanks for having me. Yeah, we do see, kind of coming into results, creeping into results in the second half of the year. And you really haven't had any trade deals yet. So you really aren't sure what that, kind of final rate is going to be. You've got a couple of deals on the table, but nothing's really signed in stone yet. So, we really think you're going to start to see it at the end of the second half and into 2026.
How much, Zach, do you think that companies are prepared for this and have the pricing power to actually respond to this versus taking it on the margins like we're seeing in some places, particularly in travel, particularly with Procter & Gamble, with an increased estimate for what kind of tariff hit they were going to take this morning?
Yeah, I think it's going to be company by company based. I think companies that have strong brands that are performing well right now can pass on some of those costs to consumers. And then you have other brands that aren't doing so well and the lower end consumer is not holding up as great. And those companies will probably have to eat some or most of those costs. It's not as simple as just, it's a 20% tariff coming out of this country. We're going to have to mark our products up 20%. That's not how the consumer operates. And economics is a little more, complicated than that.
How much are, Zach, how much are retail companies moving production back to the United States or moving production at all in response to some of these threats, given it's not clear what the rate is going to settle out at any given place in the world?
Yeah, you're not seeing it very often. You have companies that have manufacturing in the U.S. already that are, kind of reinvesting and, maybe bringing some more supply online here. But you're not seeing for instance, apparel and footwear manufacturers haven't just picked up their manufacturing and moved it back to the U.S. And I don't think you'll see that, at least not in the near future. I think as soon as automation kind of catches up and companies are able to, bring production here at the same cost as they do in Asia, then you might see more manufacturing come to the United States, but you're just not seeing it for, companies that have no exposure to the U.S.
Zach, some companies are better at managing inventory than others. And I'm thinking about some landmines that we've hit over the past few years, and Target comes up repeatedly. As we work our way through earnings season, are there a few companies that you've got your eye on that you're a little bit worried about?
Yeah, I think a lot of these companies have done well in recent years. Obviously, there are some that have kind of blown up on themselves in recent years. But I think overall, the retail industry has really done a good job of coming back from the COVID chaos and inventory there. We really think that companies are going to probably bring a lot of inventory in quicker. So you might see some inventory issues creep in after the holidays. But I think and that would just be from over ordering to kind of beat some of the tariffs potentially. But currently I don't see a lot of issues in the inventory situation.
Zach, are there some business models that just don't make sense anymore? And I'm thinking of some of these producers that were just relying on cheap labor abroad to make apparel and bring it over to the United States. And in my mind, I'm not sure that's a sustainable business model anymore.
No, you're right. I agree. It's going to be difficult now with the new tariff rates. You're just not going to have, I think it's really going to hurt the really low cost items. I think of some of the Chinese, $1, $5 brands that, have really come up in recent years. I think they're going to struggle because, 30% there makes a really big difference. Obviously, we don't know the rates out of China yet, but I think they'll probably be impacted the most.
Zach, who do you think the big winners are?
So we really like big, large global players. I think they have the ability to, they generate a lot of their revenues outside of the U.S. So, even if there is a big tariff impact, it'll be just on a small portion of their revenues. We like players that have negotiating power. So the larger players, again, have more negotiating power with suppliers. And then obviously the brands that have momentum. I kind of think of Hoka, On, some of those brands that have really done well in recent years. They have the ability to raise prices on consumers.
Over the past couple of years, there's been a theme where the strong keep on getting stronger, the big keep on getting bigger. And I'm talking about corporate America. I'm also talking about consumer balance sheets. Do you expect that to only continue and then some based on what an upper hand some of these bigger multinationals have?
Yes, we do. And retail, especially because of their negotiating power compared to, small businesses from the U.S. Someone who buys, 100,000 of a certain item have much less purchasing power than a Nike, who buys millions and millions of certain items and goods. So we think this is going to make it worse.
Hey Zach, appreciate the input. Thank you, sir. Zach Waring there of CFRA. The tariff test is still ahead of us, and there's going to be some losers. Some major losers, that's for sure.
And we're already seeing that on a stock-by-stock basis. Some companies coming out, giving forecasts, getting rewarded for it. Others, not so much. I'm thinking of Stellantis. Others withdrawing entirely. UPS, how much is this because it's a company that has a restructured business model versus the overall backdrop? But this is going to be an ongoing process of assessment, and people have different opinions about how great that will be.
Equities positive this morning. The opening bell about 65 minutes away. In just a moment, we'll get you some trade data. Mike McKee's going to break that down. Plus, we'll catch up with Stephen Stanley of Santander. Stephen Stanley is looking for zero on Friday. Payroll's Friday, and Stephen is looking for zero. We'll get into the wire in just a moment. From New York, you're watching Bloomberg. 60 minutes away from the opening bell. Equity futures positive by 0.2% on the S&P 500, up by 0.4 on the Nasdaq 100. In the bond market, 2-year, 10-year and 30-year yields are lower this morning, down by 2 or 3 basis points at the long end of the curve. On a 10-year, 438.39, on 30s, 492.45. A week full of bond auctions for Lisa, and economic data as well. So let's get you some economic data now with Mike McKee. Good morning, Mike.
Good morning, John. Well, we've got the trade balance narrower than anticipated. $86 billion is the total. That's down from $96.4 billion revised from the prior month. Imports fell by 4.2%, and exports also fell by 0.6%. These numbers basically telling us what we already knew, and I know you'll talk about this with Steve. It's going to be a little harder to untangle GDP tomorrow because of the trade impacts. We had a big pull forward in imports in the first quarter. Second quarter looks like definitely now a real rebound in that area, but that's not what is really going to be telling us what's going on in the economy. So the Fed's going to have to untangle it, as are we.
Are we getting more of a sense, though, Mike, of just what the ramifications from some of the tariffs and the trade tensions are how they're manifesting themselves in the economy?
Well, it's going to be interesting, Lisa. We get jolts today, the job openings numbers, and we have seen them hold steady, which has been kind of unusual. Quits rate actually went up a little bit the last month, and we get consumer confidence that we just talked about. But the thing that probably makes the most sense is the Fed looking past some of this data to the earnings numbers we're getting now. The P&G number out today, the idea that they're just giving you a broad guidance, and their chief financial officer says consumers are under stress. That's going to register with the Fed. And then UPS pulling its guidance for the year. They're all in the same position that the Fed is. And if the companies don't know what they're going to be doing, then the Fed is going to be sitting by and waiting to see what happens, especially once we get to tariff day on Friday.
Mike McKee, thank you, sir. With the latest, looking ahead to that Fed decision, that economic data just moments ago, the trade balance narrowing. At the end of March, that was negative 162 billion. We've basically halved that over the past few months. A lot of that was front loading going into the second quarter, and now we're starting to unwind a whole bunch of it.
Yeah, which goes to the question of how much does a trade deficit end up really getting shrunk as a result of some of the tariffs? When do we get a sense of what the full read is on the new tariff regime at a time when a lot of people say we really haven't seen the ramifications?
We get some more data through the week. The big one on Friday, payrolls Friday, just around the corner. Check this out. It's not a typo. This is what the graphic is meant to look like. Stephen Stanley of Santander, with a bearish forecast for Friday, he is looking for 0 jobs to be added, citing a quote, a reversal of the outside increase in government education jobs in June, as well as tariff-related uncertainty and a soft market for college graduates and students. Stephen joins us now for more. Stephen, good morning.
Good morning.
If you could flip this week and payrolls Friday was Wednesday and the Fed was Friday, if they had that information and it was 0, would they be cutting?
Probably not this week, but I think it would certainly nudge them in that direction. As I mentioned, the biggest piece of the weakness for me is in the government sector. And I think that's something the Fed would probably want to look through. I mean, remember, government employment was up over 70,000 in June. So this is just kind of a reversal of that. But private sector, we were in the 70s in June. I have it at 55 in July. If you go back to last year, we had 14 consecutive months of payrolls being up at least 118,000 through May. And then June, July, and August were all double digits. And I think part of what's going on there is we have a very soft job market for college grads and college students looking for summer jobs. The seasonals assume a certain amount of hiring in the summer, and we're getting less. And so I think we're likely to see a repeat of that this year, with a little bit of weakness on the private side in the summer and then hopefully normalizing again in the fall.
Can we just stay on government jobs? If we're supposedly meant to look through the weakness in government jobs, shouldn't we have looked through the strength as well?
Well, that's a good point. And I would say that definitely wouldn't.
The reason I bring that up for obvious reasons, as you know.
Government employment was very strong for a long time. And then if you remember early this year, everybody was getting very upset about the possibility of huge layoffs in federal government jobs, which, have kind of, we've had negative numbers there, but it hasn't been enough to really move the needle a lot. At the end of the day, I think, the Fed is not ignoring the government sector when it comes to jobs, but it certainly gets a lesser weight than the private sector.
There's nothing inflationary in your projection. It doesn't feel like this labor market is predictive of some sort of inflationary spiral on the heels of tariffs. So why shouldn't the Fed be cutting to potentially provide a little bit more support, especially for entry-level students?
Yeah, well, I mean, the inflation concern has nothing to do with labor costs, for once, right? This is all about the possibility, from the Fed's perspective, that you get a one-off increase in prices from tariffs, and then that somehow morphs into a more sustained increase in prices. I understand the Fed's reticence to accept the textbook view that tariffs are a one-off, right? Because we had 2021, they said transitory, and it wasn't. And you can understand they're once burned, twice shy on that. But I think this is an unusual instance in which labor costs are really not a big factor in the inflation story.
Just to build on that, there is a theory that you can't get some sort of inflationary spiral unless consumers have the ability to pay for it. Unless they can absorb prices continuing to go up, you are going to see a one-time price shock. Is that transmission mechanism broken this time?
Well, I think that's the biggest difference between 2021 and 2025. I mean, in 2021, households were flush from all the money that had been distributed by the government during COVID. And I think that helped to kind of perpetuate that inflationary cycle. We don't have that this time around. A tariff increase, to the extent that it gets passed through to consumer prices, is a loss of purchasing power for households. So I do think we'll see relatively soft consumer spending as those price increases filter through.
What do you expect to hear from Chairman Powell tomorrow?
Well, I think it's a really interesting juncture for the Fed, because I think early in the year, the tariff thing hit, and the story at the Fed was, we're going to sit back and let's watch this play out. We're not going to do anything. We're not going to engage. The problem is that this was certainly my original thought, that the price increases and the economic impacts would cycle through within 3 or 4 months, and the Fed would be able to reengage. Now it looks like it's going to drag on for a long time. You've got Bostic and others at the Fed now saying these price increases aren't going to be fully in place until sometime next year. So the game plan is changing. And I think I'm very interested to hear exactly what the Fed is thinking in terms of what do they need to see. Because if they're just waiting for the tariff effects to be totally through, they're going to be sitting on their hands for a year. They can't do that, right? So I think it'll be, even though they're not going to move tomorrow, it's going to be a very interesting meeting.
How divided is this FOMC going to be by the time we get to September?
It could be very divided. I mean, look at the June dots. We had 9 FOMC participants who wanted to go twice this year, and 7 who wanted to go not at all, and a few, kind of in the middle. So that's pretty divided.
It's going to get messier too, because by the time we get to September, we might have a decent idea of who the Fed chair is going to be as well. So you face this odd situation where you have division on the committee, and maybe the forward guidance that Chairman Powell starts to offer for 2026 kind of becomes irrelevant, because you start focusing on a different character. What does that mean for market pricing, and who to listen to, who to ignore, and how we're going to be guided into 26?
Well, it's just, as you say, it's just a lot of uncertainty, right? So the longer the process drags out, and the closer we get to May of next year, I suspect, to the extent that we don't know who the next Fed chair is going to be, the markets are going to be speculating and going back and forth depending on who, the latest leak of who's in the running or whatever. If we get a name early, and the markets conclude, okay, this person is going to get passed through the Senate and everything, this is going to be the person, then it does create a little bit of uncertainty around, as you say, does forward guidance from the current FOMC matter? I mean, you've got 19 people on the committee. You're only talking about necessarily replacing 1. So maybe the committee, the nature of the debate changes. Maybe it doesn't.
Just before you go, how much pushback have you had over the zero?
A lot of curiosity. I don't know that I would say there's been a lot of pushback, but as you can imagine, a lot of clients are very interested in getting some idea of the reasoning.
When that number drops at 8:30 on Friday, I think we'll all be thinking of you. Stephen Stanley,
my fingers crossed.
We hope you're right. We'll see. For your sake, I hope the economy's better than that. For our sake,
exactly.
For the labour market.
Yeah, although how do we interpret this if it's just government jobs that are overstated and then understated? How good is 100K and how bad is 0K? It's really going to be the market kind of parsing through this, and that's the reason why people are so focused on the unemployment rate.
This might be the last time we have a Fed meeting without knowing who the next Fed chair is going to be. Now, this, of course, would mean they'd have to have a pretty accelerated interview process through the summer and into the September meeting. But when we go into the next Fed meeting knowing who the next Fed chair is going to be, or at least having a better idea of who it's going to be, things would be a whole lot messier.
Well, in the meantime, it's going to be he's running or she's running, and we're going to look at any kind of potential dissents, the first since 1993, and say, well, that's the audition slip.
That basically describes tomorrow afternoon. OK, before we get there, let's give you an update on stories worldwide with some of our top stories. Here's our Bloomberg Brief with Yahara. Hey, Yahara.
Hi, John. Blackstone confirmed one of its employees was among the victims of yesterday's deadly shooting in a Manhattan office tower. A gunman opened fire inside, killing 4 people before taking his own life. Authorities say he intended to target the NFL's headquarters, also in the building, but ended up on the wrong floor. Meanwhile, Union Pacific has agreed to purchase Norfolk Southern in an $85 billion cash and stock transaction. It's the largest deal to ever take place in the rail industry. The tie-up is poised to transform the North American rail market, uniting Union Pacific's network across the western U.S. with Norfolk's East Coast routes, of course, pending regulatory approval. And Novo Nordisk's shares are down nearly 20% after it lowered its financial forecast in an unscheduled update. The drug maker blaming slower demand for its key weight loss drug, Wegovy. Novo also gave another update saying its head of international operations, Maziar Mike Dutstar, will become its new CEO. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the program, we'll set you up for the day ahead. Plus, we'll catch up with John Stoltzfus of Oppenheimer, boosting his S&P 500 year-end target to a street high. That conversation up next.
The main reason we're bullish, okay, is that the earnings revision breadth has exploded higher off of what was, a deep cyclical low that basically priced in a recession for the most part. So that revision breadth is guiding us to the performance that we've seen. The rolling recession call that we've kind of been talking about. Well, now it looks to us like we're having a rolling recovery, okay? And that will be further spurred by the Fed cutting rates at some point in the next year.
Mike Wilson of Morgan Stanley leaning into the bull case. In just a moment, we'll catch up with the biggest bull on Wall Street, John Stoltzfus. Look out for that conversation in a few minutes' time. As we count you down to the opening bell, let's get you some movers, your morning movers with Danny Berger. Hey, Danny.
Hey, John. A little over an hour ago, we had earnings from Boeing, a lot of earnings to sort through this morning, I should say. Better than expected. The cash outflow was just $200 million. The expectation was that it would be over $1 billion. It shows that Kelly Ortberg has been working on this turnaround. It's taking fruition. It also helps that a lot of the trade deals the U.S. has reached has involved Boeing orders, so those shares up 1.4%. We also heard from Royal Caribbean. Those shares are falling this morning 6.6%. A miss on their earnings. The issue for them were costs. Specifically, they have a new fancy cruise line that's supposed to be luxury, and it's going to be more expensive. The incremental cost that it's going to be to operate it daily is more than the additional yield that they will get from it. But the CEO saying that demand is still very strong for the cruises, so it does bode well for some of the other cruise operators. Finally, rounding things out this morning, we have Stellantis updating what they say is their hit to tariffs, $1.7 billion. Most of that is going to be coming in the second half of the year, so those shares falling 2.6%. Bernstein writing that, yes, they did give a full year guidance finally, but it was more qualitative than quantitative, and that lack of precision is disappointing, John.
Danny, thank you. Thanks for the update. The opening bell, 43 minutes away as we count you down. Here's your trading diary for today and through the week. Today, US-China trade talks continue in Sweden at 10 a.m. JOLTS data and consumer confidence Wednesday. Fed rate decision, Chairman Powell news conference, plus earnings from Meta, Microsoft. Thursday, another round of jobless claims and results from Amazon and Apple. On Friday, the payrolls report and the president's self-imposed tariff deadline. Let's stick with trade. John Stoltzfus of Oppenheimer writing, we believe enough tariff hurdles have been overcome to reinstate our original price target for the S&P 500 to 7,100 by year end. He is the most bullish on the street, and John joins us now for more. John, good morning.
Good morning, John.
How well received has that forecast been?
Remarkably well received. For all that many still consider this one of the most hated bull markets of all time. At least I would say it's one of the most doubted and has most skeptics. But when it comes to it, there is a contingency that is appreciating what's going on. And I think it's intermediate to longer term investors who are supporting this.
Is it on the edge of speculative or not?
I don't think it's on the edge of speculative. I think the memes are the speculative area. And I would still think that, around all the many cryptocurrencies and all, I still I don't get a warm feeling when I look at that.
When we look at an anatomy of the John Stoltzfus call, you had 7,100 earlier this year. You withdrew it after the April 2nd announcement, and now you're reinstating it. What's giving you that clarity? Is it just the deals that have gotten announced so far?
It was in particular, it was Japan last week, over the weekend, the EU deal. And basically, we're not big fans of tariffs, Lisa, but what we do recognize is it certainly is a way to get everybody's attention into creating a new world order in terms of trade, which allows more favorable terms for the U.S. And we think that's a positive thing. And it has to do with, I think the reason why it's a powerful call is for decades now, the whole world has been building capacity in manufacturing while we've been exporting our services and we export our innovation, but we have reduced our capacity in terms of manufacturing. The U.S., we believe, is the best customer around. We think whether it's China, whether it's Europe or Japan or other countries, they can look for other people to replace the consumer of the U.S. or business. But our per capita income and the strength of our economy makes us a customer that's willing to pay better prices, whether it's for a lunchbox or a pencil sharpener or whether it's for an automobile.
Lori Calvasina of RBC Capital has pointed to this pulling forward of expectations that's on a scale she's never seen before. The idea that so many different investors are looking at 2026 beyond 2025 before we even get the second half. Have we just brought forward the strength from next year and price that in? So after we get this third year of 20+% gains in the S&P, we're not going to get more years like that in your estimation.
I wouldn't venture to guess that yet at this point. I think I'm going to wait closer to December before, as I usually do. I'm very disciplined about that, and then I'll take a look because we've still got almost 6 months. It's 5 months left on this thing. We're rolling, and there's a lot that can happen
as we work our way through Q3. How forgiving are investors going to be of potentially weaker earnings and weaker data on the prospect of better earnings and better data in the future?
I think it's the quality of weaker data or
what
what's
do you mean
behind
by that?
it.
Explain
well,
that, John.
Exactly. If weaker data is shown to be something that is idiosyncratic related to a particular company, they'll be looking at what's the quality of management, what's the current in this cycle, where do they stand? I'm thinking of a big tech company, for example.
Are there some landmines that you're anticipating in a few months? Are there any landmines that you're anticipating over the next few months?
Right now, no, but I'm always aware that a landmine can appear, so we want to be sure to take the minesweeper out. And whenever we go out every day, we're looking for where's the bearish call, how strong is it, and also look at the bullish call and consider, is it too overly enthusiastic? Values right now are not cheap, but we would have to say, it's for the boomer generation. I think traditionally stocks are cheap at a 16 forward multiple, at a 22.5 or 23 around where we are right now. It looks high, but the composition of the investor today is decidedly different. We think a lot of that has to do, it's generationally, from boomers to much younger generations, and the reality that Social Security will not be the same percentage of income in retirement for many people. And if people start early, or if they continue in retirement, to invest suitably with exposure to equities, they may be able to retain the quality and standard of living that they have.
A year ago, investors were talking about the equal weight rather than the S&P market cap weight, simply because they wanted more exposure to the rest of the index. They were anticipating the broadening out. Where are we in terms of that? Because so far we've seen big tech leading the charge up and not showing any signs of stopping.
It is, but one thing that's often forgotten, and it's when you look at the sectors, it's industrials are leading, and industrials are leading in 2 out of the 3 ways that we look at it. We look at year to date, we look at from the peak, and we also look at from the lows. And only from the lows, I think, does industrials fail to be number 1. I think it's number 2 in there. But I think that is essentially is a clue to the fact that this market is certainly broadened since last year, and we were predicting that. We were one of the few who thought that it was going to happen. But we said it's not just about tech, because tech today is so deeply embedded in the lives of both business and consumer, helps both groups create greater efficiencies in negotiating with each other through all kinds of things. So I think I think AI is a watershed event on the timeline of technology.
Sure.
And we believe that this flows through all 11 sectors. From tech and communications themselves, where the tech is situated, but industrials, materials, energy, healthcare, financials, consumer discretionary. Everybody's on the upgrade cycle, whether we like it or not.
John, appreciate your time. Thank you, sir. The most bullish on the street, John Stoltzfus of Oppenheimer. Just got a statement from the President of the United States. I wanted to share that with you. I've been briefed on the tragic shooting that took place in Manhattan, a place that I know and love. I trust our law enforcement agencies to get to the bottom of why this crazy lunatic committed such a senseless act of violence. My heart is with the families of the 4 people who were killed, including the NYPD officer who made the ultimate sacrifice. God bless the New York Police Department, and God bless New York. At the scene of the tragic shooting yesterday evening, our colleague Bloomberg's Miles Miller joins us now for more. Miles, good morning. Share with us the latest, if you have it, please.
Yeah, that's right. We are, of course, learning the identity of one of those victims, of course, Wesley LePanter, who worked here at Blackstone. And what we know about her is that she ran the firm's $53 billion real estate fund. She was one of several people who were shot yesterday. This is we're learning more about the suspect as well. Just got some information in from federal sources who say that this suspect had been previously arrested twice in the past. One of those arrests, we are told, happened in California for trespassing. The next arrest happened for throwing a substance at a vehicle with intent to cause good bodily harm. We know that the investigation is going to continue this morning, and the mayor saying the suspect intentionally killed himself in the way he did so that his brain could be studied for CTE.
Miles Miller, thank you, sir. Plenty of updates throughout this morning from Miles. To close out the show, I think offering our thoughts to all of the loved ones of those lost and to the whole team over at Blackstone. From New York City this morning, good morning.